This is Jerry Muir, and I'm working with John Nagy, our training coordinator. We've got some other St. Killian's Church leadership on the line, and we'll get started unless someone wants to break in and offer some words of wisdom. Okay, so this is our fourth VITA session, and this will be our last. Now, when I say the last, this is the last as far as the regular VITA. We do have a session coming up in January. It's via Zoom, and it'll be the Franchise Tax Board, and I'll announce that as we get toward the end of this session. Okay, next page. Okay, so here are some of our objectives. We are going to talk about obviously California returns. We're going to talk about some of the reference material, and one of the big ones is a guide that's used by the Franchise Tax Board for VITA volunteers. So we'll get into that. Spend a little time talking about some of the contents of that particular document, and then we'll talk about the hotline phone numbers. When you're in the VITA program, you have a lot of resources. And that does include obviously the individuals who've conducted VITA before, and also some documents, and then of course telephone numbers that you can reach out as a VITA volunteer if need be to either the Franchise Tax Board or the IRS, and that would be in their VITA department, if you will. And then we'll do a quick review of the California filing requirements, exemptions, and statuses, and talk about the standard deduction, and talk about again filing requirements. And then we'll review the what is called the California Health Care Mandate. And when you hear that term, healthcare mandate, what that means is that's associated with the Affordable Care Act, and that's the act that came out about 12 years ago, and it was about I think a little over 1,000 pages of information. And what that did, among other things, it set up what we know as the Affordable Care Act. And then, of course, from that spawned certain state programs such as the California or Covered California, which some people are in as far as their health insurance. And we'll talk about filing dates and extensions, and that's related obviously to the federal filing dates and extensions. And then we'll talk about that K1. K1 is what is called an information return. And you will hear me talk about information returns. And in the VITA program, it goes anywhere from a W-2 to certain types of 1099s. There are many different types of information returns, and you'll get familiar with not all of them, but a lot of them in the VITA program. So again, we'll talk about the K1. And then we'll talk about conformity and nonconformity. And it simply means that there are certain things that California does not conform to as far as federal tax law. And we'll give you some of those examples, and then how to get into the actual software and input changes. And so that way, not only your federal, but also your California state return is correct. And then we'll review a couple of returns. One is John Morgan, and he's going to be an individual 70 years old, so a senior. And then we'll have another return, the Edward and Althea Moscoso. And in that one, we're going to talk about the Covered California. Those individuals, that married couple, will be in Covered California. And so we'll get into that. And then just a quick review. If you've been trying to certify on Link and Learn, as of yesterday, I checked, I think last night, and the state of California return has yet to be posted to Link and Learn for tax year 2022. And so what we're going to do today, we're going to have to default to 2021 for our married couple, the Moscosos. Okay, next slide. Okay, our Zoom session will go no later than one o'clock today, and we'll take breaks approximately every hour to recharge our coffee and all that. Next slide. Okay, there's a lot of different references when you're talking about California taxes. I mean, obviously, we're going to use the Form 540. We've got the instructions to the 540. And if you're trying to find certain California references, and we're talking about the most recent ones, you are not going to be able to find those today. I talked to the FTB yesterday, And I was told in so many words that there are certain of these newer documents, i.e. the 540 and the instructions, that have yet to be published. And so I don't know when they're going to come out, whether it's on Monday or 2 weeks from now, but they're certainly going to come out before the season starts. And then if you are trying to get certain documents from the FTB, when you try to go to the website and download them, in some cases, you actually have to send an email to the FTB. And I've got to give the FTB credit. They're very good about it. When you say, hey, I need this particular document, and what happens is they respond to your email, usually within the same day. And they either give you a link or they send you the document. So that's something you can do. So let's go ahead and start off with the publication 1001. And these are called the supplemental guidelines. And so what happens is when you're talking about California taxes, there's a lot of things that California doesn't conform to. So I'll give you one quick example that we're going to talk about. Unemployment compensation. In tax year 2022, the federal government will tax all of your unemployment compensation. The state of California does not tax unemployment compensation. So that's an example of what is called conformity, or really non-conformity. And so you're going to hear that term conformity and non-conformity. So the example would be not a non-conformity is that unemployment compensation example that I gave you. Conformity would be, let's say you've got someone who's working at Starbucks, and they're issued a W-2 for the wages that they've earned. Well, on the federal return, they're going to report their W-2 wages, and on their state return, they're going to report their W-2 wages. So that's an example of conformity. And then sometimes you might hear the term partial conformity. Usually we don't see that in the VITA program. But again, if we focus on conformity or non-conformity, you're usually going to be okay. And then that 1001, it's a very comprehensive document. And if you're one of those paid practitioners that volunteers in the VITA program, that will definitely help you in your practice. And then some of the other documents that are helpful. We do have a lot of individuals in VITA. We're talking about our VITA clients that are seniors. And so that means a lot of them are on pensions or some type of annuities. And so there's a publication that the state puts out, 1005, that talks about pensions. And if you've ever talked to anybody who is a tax preparer, pensions are like people. They're all different. There are thousands of different types of pensions. And sometimes when you are on a pension, you end up recovering some of your cost or basis, and that is a non-taxable event. And so we're going to show you the simplified method today when you're talking about pensions. And then also for residency, and this is something that we do in VITA, we work with our California residents. We don't do non-resident returns. We don't do part year returns. It's all California residents. And to determine whether or not you have someone who's a California resident, that publication 1031 gets into the guidelines. And then a lot of our taxpayers are going to be head of household, moms and dads who have typically minor children. And so that form 3532, that's a head of household form that you got to complete when you're completing a tax return. And then probably the most important document that you're going to bump into as a VITA volunteer, in addition to that IRS publication 4012, there is a California volunteer reference manual, and it's called the publication 5130. That publication has been published for tax year 2022, and I don't know if you have it, but I'm going to make sure that we get it out to all of the volunteers. But again, that has been published. And when you're talking about the publication 5130, it's not as voluminous as the publication 4012, but it does have a number of pages, which again are useful when you prepare a California return. Okay, let's go to our next slide. Okay, I do want to remind everybody of the leadership team. I have a tendency of forgetting, the cast of characters. Now, this may change, but essentially, most of the folks who are in the leadership team, they're going to stay in their particular position. So Our manager is still Susan. We got Fred Ramos, who's our dear leader, as we call them, and he's been with VITA for a long time. I'll be the acting site coordinator, and then Emily is going to be the assistant site coordinator. And if you haven't met Emily, Emily is a CTEC registered tax preparer. She's got a lot of experience preparing returns, and she also has worked at the Coastline College VITA site, so she's got a lot of good experience. And then we've got Mel and Art, and we'll see how they operate this year. Steve is still going to be our IT guy, and he's got a small team, and he's pretty good. He's got a lot of good experience. He's also the computer guy. So if you do not have a computer, that's okay, because when we actually assemble at the VITA site, we'll have computers set up. And of course, if you bring your computer, that's great. We'll get it situated so you can go ahead and access the software and do returns. John Nagy is running the PowerPoint this morning. He's a training coordinator. He's also an enrolled agent. He's been in the tax world for a long time, so he's also pretty experienced. And then you might have seen some letters go out, or maybe you've seen some emails. But Evelyn and Adela, they're the cover letter team. So what is happening is, or what's going to happen, the letters will go out to our former VITA clients. It will include the IRS form 13614C, which is the intake and interview sheet. That's our lead sheet. And you're going to hear time and again that that intake and interview sheet has to be completed in detail. What will happen is our preparers will perfect that document, because what will happen is our taxpayers will not complete them in their entirety each and every time. So we have to perfect them, which means we have to ask some follow-up questions. And then we still have our SPEC contact. SPEC stands for Stakeholder Partnerships, Education, Communication. It's a division within the Wage and Investment Division of the IRS. And Christine is our representative. She's pretty responsive. When I call her or send her an email, she's usually on it within a day or so. And their Orange County contacts remain the same. Raven, she is new this year. And then Omeed's been around for a long time. And if I remember correctly, I think we've actually used Omeed a couple times in the past. He speaks Farsi. And so sometimes we'll get taxpayers who speak Farsi. And I've reached out to Omeed a few times to help with, I guess it's called translation or interpretation. I guess translation would be written documents, and interpreter would be the oral, if you will. Okay, any questions about the leadership team before we move on? All right, and let's go to our next slide. Okay, so once again, hopefully you've had a chance to at least jump into the practice lab. When you hear the term practice lab, it's part of that Link and Learn, and it uses a professional tax preparation software known as TaxSlayer or TaxSlayer Pro. And so those are interchangeable names, TaxSlayer or Practice Lab. The Practice Lab is what you use to certify to become a VITA volunteer. It's free. You do have to register for it. And then you also have to register to certify. But once again, as of yesterday, the software does not include the state returns. I don't know when California is going to be loaded on the Practice Lab, but I know it's going to be soon, probably not months, but certainly weeks. And then when you're talking about the actual software that we're going to use with our live clients, I actually have that loaded up for my business right now. I'm a tax guy, and California is not even loaded right now for the tax professionals. So the short answer is stay tuned. The TaxSlayer Pro folks will load that up, and then we'll have that additional training in January, and you'll get plenty of time on the California software. And then, as I mentioned before, if you want to look at the tutorials, there are tutorials on the Practice Lab. They are not perfect. I don't think anything is perfect when you're talking about the tax world, but they are useful. And then there's also practice returns that are loaded on the Practice Lab. And in the practice returns, what they have is they have check figures, and that's an accounting term, simply meaning you can prepare a return, and then you can check that or compare that to the check figures in the Praxis lab. And if you are working on those practice returns, ignore, do not attempt, do not worry about anything that's married filing separate. As we mentioned before, in the state of California, in the VITA program, we do not prepare a married filing separate. And then what happens is people say, okay, got it. Now, where do I go to get my married filing separate return prepared? You simply mention to them that there are many practitioners in California. You don't want to give a name. We're not going to go ahead and recommend a particular person, but you can recommend them to the California Society of Enrolled Agents. You can recommend them to the California Society of Certified Public Accountants. You can recommend them to the California Society of Tax Consultants, and they can jump on the internet. They can plug in the particular society, and then once they enter perhaps a zip code, then it'll drill down to their area, their town, and give them a laundry list of preparers. And then sometimes what will happen, people say, well, they charge. And well, the answer is yes, of course they charge. They're in business. And sometimes they charge a modest amount, and sometimes they charge a lot. But the bottom line is, if you don't want to do your own return, can't do your own return, and it's outside of the scope of the VITA program, then your options do include going to a paid professional. There's also what is called the low income tax clinic, but you have to search them out. The closest one that I'm familiar with is in the city of Santa Ana. And if you qualify, meaning the VITA client, then they can go ahead and go to the low income tax clinic which either charges a modest amount, or in some cases they do not charge. But again, our response will be, if it's out of scope, it's out of scope, and then there are options. We typically cannot and will not hold the hand of the VITA client, because that's very time consuming. If you've been involved in VITA, there's just certain things that we can't do, because we don't have individuals who are working full time in the VITA program. They typically work 1 day a week, maybe 2 days a week, but not 40 hours a week assisting VITA clients. Okay, how about the next slide? All right, and so when you're talking about the resource material, the Pub 5130, this is a good resource material for California returns. And it is for tax year 2022. It's been published. The publication date is October 14th of 2022. So it's relatively new. And you'll be able to find that. If you can, I'm going to make sure that John and the leadership team, they've got a current copy of the 5130. And during our January training, the Franchise Tax Board will reference that document as they go through the software. So you have a basic understanding of how to utilize the California return, or prepare the California return utilizing the tax software we call TaxSlayer. Now, before we go from this, I just want to point out a couple things. When you're talking about the 5130, it has a number of chapters, if you will, talks about what we call the scope of VITA. It certainly has the new information regarding the state standard deduction. It talks about filing requirements of the state of California. It also talks about what you've heard before, at least you've heard me say before, conforming and non-conforming. And so once again, when you hear the term conformity, it simply means California agrees, so to speak, with federal tax law. Non-conformity means California is going to do what they want, because they have that authority under the Revenue and Taxation Code, which is the tax code for the state of California. And then in this particular publication, the 5130, it does talk about the California healthcare mandate. We will introduce you to Covered California. And thankfully, in the VITA program, a lot of our clients who cannot afford health insurance, they're able to go to Covered California. They're able to purchase modestly priced health insurance. And then a lot of our VITA clients are also in what is called the Medi-Cal program, which means they apply, and because of their financial situation, they're able to get health insurance, basic health insurance for themselves and their children. And then also in this particular publication, it does talk about what are called utilizing the tax preparation software. It gives you some pointers on that. And then it does talk about that Schedule K1, which we are going to talk about this morning. And then there's a new credit that this particular publication talks about. It's called the Foster Youth Tax Credit. And that Foster Youth Tax Credit, if I remember correctly, I don't think we had it last year. I think it's new to this year. And then it talks about the runner's credit, which is on that California return. It talks about amended returns, and it also has information pertaining to the Franchise Tax Board VITA team, which are pretty responsive, Okay, let's go to the next slide. So this is just page one of the California Volunteer Reference Manual. This is approximately, I think the last time I looked, and there's about 47 pages. So again, a lot smaller, a lot shorter than the publication 4012, but a good reference material for you to jump into and make yourself smart on the issues. And here's another thing. This is what I would do. Sometimes I'm sitting with a non-paying client, a VITA client, and they'll ask me, "Hey, Jerry, where'd you get that?" And I said, "Well, this is part of the tax law." Like, "Yeah, but where'd you get it?" So open up some type of publication from either the state or the federal government, and we'll go to the topic at hand. I'll say, "This is where I got it." The answer is 4, and this is on page 62. And what that does, it's not like you're trying to boast or anything. You just say, well, if they've asked the question and you've got the answer, give them the answer. And I do that all the time, and I think it builds confidence with our VITA clients. Okay, let's go to our next slide. Okay, this is probably a work in progress. This is the hotline phone numbers. And when I looked this up, I did not see any weekends. And so I'm going to conclude that the Franchise Tax Board will have a VITA volunteer hotline that is operational on a weekend. But right now, this is what I was able to come up with, that telephone number. Again, this is only for VITA volunteers. And I would recommend, before you make a phone call, if you're tackling a particular issue and you're not quite sure, you should reach out to either your assistant site coordinator, your site coordinator, your training coordinator. Someone within the VITA team at St. Killian's most likely will probably have the answer. And then if not, if you need to, then of course reaching out to that FTB hotline. And then the IRS has the same thing. Their hotline, of course, is open during the week and on the weekends. And same thing, if you can't find an answer and you've talked to the leadership team at St. Killian's, you've talked to some of them more senior folks, and then, yeah, at the end of the day, yeah, you've got to reach out and make a phone call. And the same thing applies to the folks who are responsible for electronically filing our returns. Sometimes returns will be rejected, which means we have to perfect those returns. And what that means is we've got a small cadre of folks at St. Killian's. They'll be reaching out to TaxSlayer Pro and asking them what's the issue. And this does happen, again, for a small cadre. This will happen where we're trying to email, or trying to e-file a return, but we are unable to get that to go through for whatever reasons. It could be a transposed number. It could be something that's incomplete. And this happens all the time. I don't know what percentage. I think last year when I was an ERO at Coastline College, I think maybe about 6 or 7% of the returns would reject for whatever reason. So we have to perfect them. And that's just the way it goes. If you're a paid practitioner in your practice, same thing. It doesn't matter what type of software you use, you probably have a rejected return here and there. So you try to perfect it. Sometimes you got to call the software company. That's just the way it is. And I did mention for the software that we use for a VITA program, sometimes we're going to e-file the return or attempt to e-file the return. And then what will happen, there'll be an issue with the software. So what that means is we, meaning someone on the leadership team, will call the software company and say, "Hey, your software is not processing this particular return. What's the deal?" Sometimes what happens is the software company, TaxSlayer Pro, they've got to go with their software programmers, engineers, and they have to fix the software. That does happen from time to time. And so if you hear that, that's just the way it goes. We don't have any control over that. We're not part of that TaxSlayer Pro team. But again, we have to bubble up our concerns to them if we have an issue with the software. So it does happen from time to time. All right,
Hey,
next
Chair,
slide.
we have one question
Sure.
in the chat. Can we order a printed 5130?
Ooh, good question. And the answer is, I don't know, but what I can do, I've got a contact at the Franchise Tax Board. I can see if we can get 5130s sent to the church. That's a good good question. I don't know how many we need. And John, quite frankly, I don't know if we have 40 or 45 people on our team, but maybe we can order one for each individual. Okay, any other questions, John? I guess not. Okay. All right, so let's run through this. This is the standard deduction for the state of California. And when you're talking about a standard deduction, if you're new to VITA, what that simply means is your taxpayer is going to take a standard deduction or an itemized deduction. And what that does is that simply reduces the taxable income, which reduces the tax. And so you're going to hear that. And you don't have to memorize this stuff because all of this is built into the software. And so that's all you have to concern yourself with. But this is just a reminder that the federal standard deduction is different. And sometimes you get that question from a taxpayer. They'll say, well, why are these numbers different? And I always tell them, well, federal tax law is a dog and state tax law is a cat. It's two different animals. And that's the way it is. But again, these are the standard deductions that you'll see on the California and also on the federal return. And then when you hear the term exemption credits, you do not have federal exemption credits. That went away with the Tax Cuts and Jobs Act, where you used to have that amount, that personal exemption and dependency exemption. We now have federal qualifying child, qualifying relative for the purposes of tax credits. But the state of California, they still have what is called an exemption credit, which of course helps reduce the tax for a California resident. Okay, and all right, next slide. And then again, the exemption credit for dependents, this is California, that's 433. So that's fairly generous. And when you look at a California return, if you have someone who's got 2 or 3 or 4 children or dependents, then of course that adds up. And again, that simply reduces their tax at the end of the day. And you'll see this in the VITA program. A lot of our VITA clients will get refunds, and some of these refunds are substantial. I know at least the site that I worked at last year, some of our taxpayers, they would walk out with a federal and a state refund combined of $6,000, $8,000, $10,000 because of the various refundable credits and the fact that some of these exemptions and these non-refundable credits reduce their tax to zero. And then, of course, with refundable credits, they get money back along with the tax withheld. So you'll see that. Sometimes you'll prepare a return and you shake your head and say, well, how can this be? And they've got, again, $10,000 or sometimes $12,000 refund. Well, that's the reason why: the credits and the exemptions, and of course withholding. Next slide. Okay, and again, you don't have to memorize this, but when you're talking about filing requirements, and this is probably something you ought to remember, probably the mantra is when people come to our VITA site, they generally have a filing requirement, or they want to get their return filed, even though they don't have a filing requirement. Maybe they've got refunds coming to them, or they are entitled to certain types of refundable credits. And the only way you can get a refund if you have a tax withheld or refundable credit is to file a return. And so the bottom line is when people show up at the site, the vast majority of them are going to have a filing requirement or they want to file a return. And of course, we're going to accommodate them. Now, when you're looking at the filing requirements, if you go to page 25 in that publication 5130, that's the state volunteer reference guide, you're going to see this is the requirement to file a return. And so if you're single or head of household and you're under 65, then of course, your AGI, adjusted gross income, or your gross income have to be those numbers that are reflected on the screen. And it's different if you're over 65. And you're going to see that when you're over 65, both federal and state tax law treat those taxpayers differently. And when you're in the tax world, you have preferences or considerations for different types of taxpayers. So, for example, if you are disabled, there are certain types of deductions you can get. If you're over 65, certain type of deductions you can get. If you're visually impaired, or if you're blind, there are certain deductions you can get. If you're a member of a Native American tribe, there are certain things that apply to you that do not apply to non-Native Americans. Same thing with military personnel. There's certain provisions that apply to them that don't apply to others. So you're going to see that, and that's just the way it is. Okay, so for married folks, and that RDP is an acronym for Registered Domestic Partner. I don't see that very often, but it's still on the books. And of course, your filing requirement is higher for married folks, and that makes sense because you got two as opposed to one. And you can see those amounts on the screen. And then, of course, it's different if you're over 65. And then there's a term, we mentioned this I think last week. We used to have what is called a qualifying widower with dependent child. And now that term has changed, a qualifying surviving spouse. And that term is used for both federal and state tax purposes. And of course, if you are a qualified surviving spouse, of course, you have to qualify, obviously, then your filing requirement is going to be different than married filing joint. And you can see those numbers on the screen. Again, you don't have to memorize them, but sometimes people will ask you, what's the filing requirement? So you can go to, for at least for the state of California, you can go to that publication 5130, page 25, and you can show your VITA clients, these are the filing requirements. And this is the general rule. And then, as I mentioned before, you have general rules in the tax world, and you have exceptions to the general rules. And then when people say, well, Jerry, there's an exception, I'm thinking, yes, there's all sorts of exceptions. And sometimes you'll spend a couple of weeks trying to list all those exceptions. But again, if you go with the general rule, you're probably going to cover most of your taxpayers. Okay, any questions about filing requirements that you can find on page 25 of the publication 5130? All right, let's go to the next slide. Okay, so now we're going to jump into nonconformity. And this is something that thankfully in the VITA program, you're only going to bump into just a few issues. And so this is something you'll be able to tackle. But you want to have an awareness of this. And certainly when you're talking to a client, sometimes they're going to say, well, the federal government, they don't tax this, or the federal government does tax it. And you can say, well, the state of California is not the federal government. The state of California is going to do what they're going to do under that revenue and taxation code. And so starting off with itemized deductions, we know itemized deductions are approximately, last time I looked, about 10 to 12% of our filers. So it's not a big amount. And the reason it's not a big amount is because when the tax law changed back in late 2017, essentially the standard deduction was doubled for most taxpayers. So it eliminated most of those VITA clients who are going to be filing and using itemized deductions. But sometimes you will have a client that has itemized deductions, which we've talked about, and there's different things. And keep in mind, itemized deductions on the federal side of the house can and often are different than on the state side of the house. And so you need to be aware of that. We're going to show you some things here today where the itemized deductions for California are different. But when you're talking about the charitable contributions, and you rarely see this, I think I've seen it just a few times. Charitable contributions are limited by the federal government, and they're limited by the state government. And so for the state government, if you're making charitable contributions, you're limited to 50% of your AGI. You're probably not going to see that. We've got a lot of generous people in the world, but most people don't donate to charities over 50% of their AGI. And of course, the same thing for the federal government. There's limits, and the last time I looked, limits for tax year 2022 are going to go down to 60%. They used to be 50, but now they're going to go down to 60 for the federal government. And then student loan forgiveness, and we're talking about the state of California right now. So what happens is you've got someone who borrows money, they go to college, and they end up passing away. So that's an example where there's going to be student loan forgiveness, and someone who's disabled, or maybe a school closure. And so, for example, and I've seen this with my own eyes, you've got a proprietary school, they will close down, the students are upset, they don't get their diploma, they transfer to another school, and they owe money on their student loan. And then what happens is on their California return, they don't have to report that student loan forgiveness or what is called cancellation of debt if there's a school closure. And again, that's on their that's on their state return, And then another thing, I remember when I first started doing VITA, never saw this. Then I started to see it once in a while, and I would see it a lot on VITA returns, where individuals will get divorced, and they are required to pay alimony to typically their former spouse. And when you have that, and then what that means is your California return is typically going to be different than your federal return, because on your federal return for new divorces that have occurred after 2018, on your federal return, you don't report your alimony that you have received, and you cannot deduct alimony that you paid. And that's why I call it on a new divorce. Well, California, they do not conform to that. If you're receiving alimony, you're going to report it on your California return as income. And if you pay alimony, you're allowed to deduct it on your California return. And then I've had this before. I've had people ask me, Jerry, what's alimony? Well, alimony is you're again typically getting divorced, typically to a former spouse. You can pay alimony to a current spouse. That it is possible, but usually it's a former spouse. And alimony has to be directed by a judicial official, magistrate, judge, sometimes commissioner, and they have the statutory authority once you come in front of their court to issue a court decree that you will pay alimony to this person over here. If you're making voluntary payments to someone, it simply means that you're a nice person, and that's not alimony. Alimony is a compulsory payment that you are required to make according to a court order. And so you will see that from time to time. For whatever reasons, people are voluntarily giving their former sweetheart some money, and it's not in accordance with the court decree. That's not alimony. That's just giving money to people. I would call that a gift. So you want to make sure you don't have to actually look at the court document that orders them to pay alimony, but you want to ask them, is this in accordance with a court order that you have to pay alimony? And if they say yes, there's a court order out there. I got divorced in 2020, and the judge says I got to pay X number of dollars to my former spouse, and that would be an alimony payment. Okay. Next slide. Okay, other things that California doesn't tax. And so when you're talking about interest income, and there's a lot of people today, when they hear the term interest income, they go, what are you talking about? I've got a bank account. They don't pay any interest. Some banks do not pay interest. And in some cases, although I don't think this is the case in the United States, in some cases, you have to pay the bank to keep your money on deposit. But since we're not working with international taxpayers, we're going to focus on that interest income that not all, but some people receive from their bank account. Or in this particular case, this would be interest income from a savings bond. And so when you talk about what are called government securities, the U.S. government, they will issue these securities. And the reason they issue these securities is because the U.S. government, they need money to pay their bills. And if they don't issue these securities, that means they don't have monies to pay the bill. And then you have a really bad situation that occurs. So what happens is savings bonds are still around, and you earn interest. And so that interest that you earn is reported on your United States tax return, your Form 1040. And then keep in mind, when you jump into the publication 4012, when you're talking about interest income, there's two ways to report it on your federal return. One way is to report it when you cash in your savings bond, and the other way to report it as you earn interest. Most people will report on their federal return their savings bond interest when they actually cash in their bonds. And there's a couple ways you can cash in your bonds. You can go to your local bank. You can send your savings bonds to the United States Treasury and you redeem them for cash. But again, for tax purposes, California tax purposes, that interest is not reported on the California return. And then you have other types of securities, and I'm not a finance guy, but you have U.S. Treasury bills. Most people you bump into are going to have savings bonds. And then sometimes you're going to have a senior citizen that's had some type of government security for 40 or 45 years. And what will happen is, and some of them were aware of this, those securities are no longer earning interest. And that's probably a discussion they probably want to have with their financial advisor, but that does happen. Here's another thing that California doesn't tax, and same thing with the federal government. When you have an income tax refund from the state of California, it's not going to be reported on your California return. Kind of like the same thing when you receive a federal refund, you don't put that on your federal return. And then we will talk about this morning about what is called the tax benefit rule. And in fact, I'll just mention it right now, but I'll mention it again. When you hear the term tax benefit rule, what it means is, for our purposes, in tax year 2021, an individual will report their California income tax that they paid on their, that they paid and they've reported on their Schedule A for 2021, i.e. their federal return. And then subsequently, which means they've taken a benefit, tax benefit, and then subsequently in 2022, they get a state tax refund. Well, if they've taken the benefit in 2021 and they've received the refund in 2022, they can't have it both ways. So that means in 2022, on their federal return, their state tax refund is going to be a taxable event. And we're going to show you that today. So again, that's called the tax benefit rule. And then unemployment compensation, and you want to put your hat on, because if you've done returns in the last couple of years, you saw back in tax year 2020, the federal government allowed individuals to exclude a certain amount. So in tax year 2022, on your federal return, your unemployment compensation is going to be a fully taxable event. On your California return for 2022, unemployment is not taxed. And that probably makes sense, because if you're on unemployment, and then you get stuck with paying tax at the end of the year, for a lot of people, it's a tough thing. Now, this is something that we've seen in the last couple of years. You probably see a little bit of this in 2022. You'll have individuals who will be on unemployment and they did not have any type of withholding, and that would be federal withholding. And then on their US tax return, their Form 1040, they go, well, why do I owe money? And your response will be, well, the reason you owe money is because you did not have withholding on your unemployment compensation, and the federal government taxes unemployment. And unfortunately, you're going to see that on a number of things. And so probably, maybe they're going to cry on your shoulder, but probably the best thing to describe to the taxpayer is, if they have income and they don't have withholding, that's usually where they have that issue at the end of the year where they're going to owe tax. And again, for unemployment compensation on your federal return, that happens a lot. For California, you might have an individual that has perhaps maybe insufficient withholding on their wages. And in that particular case, they may have a big tax bill at the end of the year. But that's something you want to talk to them about and say, there's a couple of ways to do it. If you owe tax at the end of the year, you can simply pay your tax, and then you can prepare for the next year by making what are called quarterly payments. And then that way you're not going to get clobbered at the end of the year with a large tax bill. So again, unemployment compensation not taxed by California. Another item that's not taxed, and this is done automatically for unemployment compensation, Social Security benefits. We have a lot of our clients who are on Social Security. And as I mentioned before, most of your Social Security recipients are going to be in their at least in their 60s, at least in their mid 60s. You might have someone who's on Social Security I think the youngest I've seen someone who's drawing benefits would be like age 57. So what that means is there's exceptions to the general rule. But the general rule, I think you hit, I think for me, I got to be like almost 67 before I get my Social Security benefits. But you do have people on what are called actuarially reduced Social Security benefits, which means they take it at age 62, and those are actuarially reduced for the rest of their life, and they're drawing benefits. I think I knew two people who started taking it when they were 62. But the bottom line is, federal government, you're going to report it on the software, and then in some cases, a portion of those benefits will be taxed by the feds. But for the state of California, your Social Security benefits are not taxed. And then you also, and I've seen this a couple times, and I know there's people who work for the railroad, but I guess I just don't bump into them that often. But people who work for the railroad, they've got their own system. So what that means is when you're talking about retirement, not everybody in the United States who's working participates in the Social Security system. I'll use, for example, my former boss. She's probably in her mid to late 60s right now. She will never receive Social Security. She has a different type of pension plan, and that's just the way it is. There's certain people, or certain organizations, I should say, that are allowed to opt out of Social Security, and they do not pay into Social Security. You will see those individuals. And of course, another system is the railroad system. And it's basically like Social Security, but again, it's a different system called railroad retirement. And same concept. If someone comes to the VITA site and they go, "Hey, I used to work for the railroad." Okay, great. What do they give you? They're going to show you some type of 1099, and you're going to enter that into the software, and they'll be treated like Social Security benefits. So again, the federal government, you got to report it on the 1040. For the state of California, it's not going to be a taxable event. And then another item that you'll see, and I've when I first started VITA, very few people gambled. And now for some reason, maybe either I bump into a lot of gamblers, or maybe a lot of people are gambling. So you have people who are purchasing lottery tickets, and then sometimes they win. So if they win a California lottery, then they don't have to report it on their California return. That's something that they can exclude from California gross income. Now, if you win some type of lottery on your federal return, whether you win $1 or $1,000, whatever you win from a lottery on your federal return, you got to report it. And sometimes, and you'll see this, you'll see people who say, "Well, I did not receive a document from the casino. I did not receive a document from the government." And I always tell them, yeah, that happens. In some cases, you're not going to receive a document. It's called an information return in most cases. But what that means is, on the federal side of the house, if you have what is called gross income, well, you're going to report it on your tax return unless it's otherwise excluded. And so here's an example of something that is excluded from California wages under that revenue and taxation code, and that would be a California lottery winning. Again, reported on the federal return, not reported on the California return. And then for unemployment, again, when you're talking about entering that data, it's going to be a 1099 the taxpayers receive. We're going to enter that data in the software, and the feds will tax it. But what will happen, it'll automatically carry over to the state of California, which means it will show the amount of what is called subtraction from California income, which saves you time. Certain things you have to enter in manually. Unemployment and Social Security benefits, you do not. You simply have to enter that into the federal return, and it'll carry forward to the state return. Okay, I'll hesitate and see if anybody has any questions, John.
There's nothing in the chat. I mean,
Okay,
I've answered one, but
all right. Okay, then let's go to our next slide. Okay, this is what is called the California Healthcare Mandate, which simply means if you're a California resident, you either have to have health insurance, or you have to qualify for what is called an exemption. And if you don't, then you have to pay what is called an individual share responsibility penalty. And so this is basically modeled with the Affordable Care Act. And so if you remember when that Affordable Care Act came out, on your federal return, you had to have health insurance. And if you didn't have health insurance, then you had to have some type of exemption. And if you didn't have an exemption, then you had an individual share responsibility payment. Well, the federal thing went away. Congress repealed that penalty a few years ago. But the state of California, they've got their own legislation. And so if you're a California resident, then you have to, of course, adhere to California law. And so for some people, not a lot, but some people in the VITA program, they don't have health insurance. They don't qualify for an exemption. And in that particular case, a penalty will be calculated on their California return. And this is something that you'll see from time to time. Now, thankfully, a lot of our VITA clients, they do have either health insurance through work, or they have health insurance through maybe some type of governmental entity like Medicare or Medi-Cal. When you're talking about seniors who are on Social Security, not all of them, but a lot of them have signed up for Medicare. And Medicare, of course, is what is called minimum essential health coverage. And thankfully, again, most of our VITA clients, when they come to the site, they have some type of health coverage. And that's the whole thing about that minimum essential coverage. You're talking about, for lack of a better term, health coverage from head to toe, because you can go out and buy a health insurance policy that is focused on certain things. It could be focused on ocular care. It could be focused on heart care. It could be for a pregnancy care. It could be just for cancer care. That is not minimum essential health coverage. You have to have a head to toe coverage, which means if you have an injury or if you have some type of disease somewhere in your body, then you're going to be covered by that health insurance policy. Now, keep in mind, when you have health insurance, and we probably all know this, usually there's some type of out-of-pocket payment if you go visit the doctor, or if you visit the emergency room, they charge you $100, something like that. Well, you still have health coverage, but you still have, or you simply have some type of co-payment or payment you have to make. And that's very typical with insurance policies. But again, if your insurance policy covers you from head to toe, then you're good to go. Also, there's policies for optical insurance, which could be, glasses, maybe an eye checkup by I think optometrists. At least they look at your eyes. There are different types of eye people. You have ophthalmologists, which are medical doctors, and they do everything from checking your eyes to doing eye surgery. You have optometrists, and they check your eyes, give you glasses. And then you have opticians, and those are the folks that will fit you for glasses. But again, if you have that type of optical or eyeball insurance, that is not minimum essential health coverage. It's simply eye insurance of some kind. Okay, so again, that's it. The takeaway, your clients are going to have coverage. If they don't, they have to get an exemption. If they don't, then they will have to pay that individual share responsibility penalty to the state of California. And if you look at the very bottom of the screen, it talks about the franchise tax board form 3853, which is built into the software. And so if you need to indicate an individual is eligible for an exemption, or they have to pay that penalty, then of course you'll populate the 3853. And what I have done is I've asked our franchise tax board representative to go through this in detail during our training in January, which will be via Zoom. And if I remember correctly, it's going to be on a Saturday. In fact, I'll just announce it now. It's going to be on a Saturday, January 14th at 10 o'clock. And then I'm going to ask if we can get that recorded, Steve and our IT team. And then that way, if you can't make that event on the 14th of January, then you can go ahead and take a look at that. And then here's a tidbit for our volunteers who are either new or newer. When you come to the VITA site, we're not going to throw you in the deep end and watch you swim. What we are going to do, we're going to have additional training on both the California and federal return. Some of it will be formal, some of it will be informal. But at the end of the day, you're going to either be comfortable preparing a return, or you're going to be sitting with someone and you're going to be reviewing a return, or they're going to be reviewing a return. So you have that additional experience, that additional help, if you will. And then, like I mentioned, if you're preparing a return and you don't feel comfortable, there's always someone in our VITA team that you can reach out to either via Zoom, telephone, face to face, and say, "Hey, how do I do this?" And that's going to happen. Okay, let's go to our next slide. Okay, and so when you're talking about covered California, and I'll have to confess, I'm not in covered California. I'm aware of it. I've gone to the website, but I've never purchased insurance through covered California. And for those who have purchased insurance and you're aware of it, then you're probably a lot smarter than me on covered California. But covered California is simply a health program, if you will. And what happened is when the Affordable Care Act passed, then there was a federal marketplace, a federal exchange where individuals would go to the exchange if they qualified, and they would purchase health insurance and they would pay a premium, and the premium would be lower because it was subsidized by the taxpayers. Well, what happened is the federal government said, okay, states, if you have your system that you want to use and you're not going to use the federal marketplace, then you do so. And I know there's a few states that have their own, and of course, California is one of them. And so covered California, it's been around for a number of years. And this is where individuals, as I understand it, they have to qualify, and they go to covered California and they purchase insurance. They look at different products and they're purchasing that minimum essential health coverage, and they're paying premiums. And of course, the premiums are lower because they're subsidized by the taxpayers. And when you hear that term subsidized by the taxpayers, what that means is an individual then is required to file both a federal and a state return. And when they file the return, that they may actually, because of the subsidy, they may actually get more money back. But the bottom line is that they have to file a return. And sometimes when they come to the VITA site, they don't have the documents that they need for us to enter that data into the software. So this is non-negotiable. If someone comes to the VITA site and they go, "Hey, I was in covered California, I purchased insurance, it was subsidized, I'm ready to file my return," our question to them is, where are your documents that have been issued to you by covered California and the IRS? And they've got to bring those documents. And typically they're going to bring two documents with them. They're going to bring that IRS form 1095A as an alpha. And that's the one that talks about that subsidy that they have received and the insurance premiums that they've paid. And then they're also going to bring with them the franchise tax board document, the 3895, which is the California Health Insurance Marketplace Statement. So between those two documents, we're going to be able to enter the data into the software and actually prepare the return. And if they are eligible, they might be eligible for what is called the premium tax credit. And of course, on the California return, it's called the premium assistance subsidy. So again, that could happen. Or conversely, you might have someone who's in covered California and they receive too much of a subsidy. And this is really important, especially if you haven't seen this before or if you've not been in covered California. And I like sharing this story because it's really appropriate. A couple of years ago, we had a taxpayer. This is a VITA client who owed money. Obviously, something changed in their life. And so I sat down with her and I said, okay, you have to pay what is called this excess amount back. So something happened in your life. What happened in your life? She goes, well, I went into covered California. I was making about $20,000 a year. I bought my insurance. It was subsidized. And then a couple months later, wonderful news came and I got promoted at work, and she was making at that time well over $60,000. In fact, I don't even think she was eligible for VITA because we usually limit it at $60,000 of income. But anyway, she was making the big bucks. And I said, okay, then if you're making the big bucks, then you're required to go in to covered California because something's changed in your life and you're required to update that information in covered California because the amount of your subsidy is going to change. And so this is the takeaway. And again, I have not been in covered California as a client, but if someone is in covered California and something big has changed in their life, they've gotten divorced, they've gotten married, they had a baby, they moved, they are making a lot more money, they're making a lot less money than when they first entered that data in covered California. It behooves them to go back into covered California, indicate those changes, because the amount of the subsidy is going to change. Because the last thing you want to do is to be over subsidized. If you're over subsidized, you got to pay back the subsidy. If you're under subsidized, then of course you're going to enjoy that premium tax credit. So again, this is something that you want to at least mention to the taxpayer. Some individuals, they enter their data and they walk away and they don't do anything, but they have to be aware that they need to make those changes to avoid being over subsidized. And another thing you could probably kind of point the way, if you will, they are called navigators. That's the last term that I've heard. And those are the individuals that assist people.
You're muted.
Hey, John?
I tried to
John?
mute myself and I muted you. So go ahead, you're on now.
Okay. How much do we miss? Just a little bit?
Just a couple seconds. Yeah. And it's 10
Okay.
o'clock
All right.
now too. So
All right, great. And so once again, covered California, you're going to see a lot of this. And the takeaway is secure those documents. And typically the 1095A and the 3895 from California, those are the documents that the taxpayer will have in order for us to prepare the return. If they don't have it, we're not going to chase them in the parking lot and chase them in their car. We're simply going to say, we can assist you, but you got to bring those documents. There's certain things that are non-negotiable. We got to have these documents. And I've seen it at VITA sites that I've worked at where people say, well, I didn't get it. And I always tell people, I understand, it's not a perfect world, but what you can do is you can get it. You can reach out and you can find those documents, secure those documents and bring it to the site, and then we can help you out. Other things that you're going to see and this is not related to covered California, you're going to see individuals who say, yes, I have insurance. And so again, that'll beg the question, what type of health insurance do you have? And they may be a veteran, which means they're administered by the Veterans Administration. We've already talked about Medicare. They may be an individual who receives some type of health insurance through their employer, which means they have health insurance, or they may be on Medi-Cal, which is a program for low-income individuals. And obviously it allows them to have health insurance, not only for themselves, but also their kids. Let's see, other things that you might bump into when you're at the VITA site, that premium assistance. And again, that's that health insurance assistance, a subsidy. You might have a taxpayer with the form 3849. And we've already talked about the 3853. That's the document that's built into the software for exemptions, or if they have to pay that individual share responsibility penalty. And then there are other publications that are at the bottom of the screen here, the 3949A, which talks about the subsidy, and other documents talking about the health insurance program. All right, so that's about all that we need to talk about on this screen. And John, I'll hesitate, see if anybody has any questions. And another thing,
I'm answering
John,
one in chat here. Is Medicare?
John, you went away. Are you thinking?
Maybe I can jump in with my chat question. It was, you stopped talking when you were about to explain what a navigator is.
Oh, a navigator, that would be an individual. Typically, they're an employee of a nonprofit. And what they do is they are a subject matter expert. They'll help individuals log into covered California, and then enter the data that the individual needs to enter so they can qualify for that subsidized health insurance.
Thank you.
And then I'll leave this. If you are in covered California and you're a VITA volunteer, I would ask when you come to the VITA site, please hit me up, Emily, John, leadership, because it's really nice to know a little bit about Covered California. I'm not in Covered California, and I want to get a little bit smarter as we go through the season. So if you are familiar with it, it's great to sit down and maybe you want to give a short little tutorial on Covered California. That can only help our volunteers.
Jerry, this is Bruce. I have a question regarding Covered California. It seems like every year we have a few people come in where one spouse has Covered California and the other has some other kind of insurance or whatever. And when you do that and reconcile that, it's going to look at total income. So isn't that a problem with putting that in that way, and how
I
the
don't-
reconciliation is calculated and any penalty, et cetera?
Yeah, I don't recall that being a problem, but I know as we go through this process, and I know in January when our FTB folks give that Zoom presentation, we're going to ask them to get into the details of Covered California. So that's something that we'll hit in mid-January.
Great.
This is Barbara Harris. Can you hear me?
Yes, Barbara.
We had an instance just like that with Covered California. One, the husband was on Medicare, the wife worked, and and they put her on Covered California. And what they didn't realize for the income, it included all the income, including capital gains, his Social Security, and everything else. And so he ended up with a big, like $13,000 bill. And so what we found out is to mitigate that bill, you can contribute to an IRA and reduce the income.
You know that's true. I mean, individual retirement.
And as
Yeah.
long as the tax return was not filed, they had up until the time to file the tax return to make the contribution, because it basically wiped out anything they were subsidized. It would have been cheaper if they just went on the market and bought insurance.
Yeah, that's a good point. Since you bring it up, that's something that I learned from my wife. She was a site coordinator a few years ago, and she would mention to taxpayers that owed that if they want to, it's all voluntary, they could open up an individual retirement arrangement, and they can go ahead and make a contribution before the filing deadline. And then, of course, they would put that on their return. They would reduce the amount of their taxable income, reducing their tax. And that's something that they can do. That's a good point.
Right.
All right, thanks. John, are you back, or should we march on?
I'm back. I'm just struggling with Wi-Fi problems. So I don't know. Is it about time to take a
gotcha.
break anyway?
Yeah. Let's take a break. I've got 10:07. Let's come back at 10:17 and we'll jump into the rest of our PowerPoint. I'll see you in 10 minutes. And we're still talking about the Covered California, the Affordable Care Act. And so here are some takeaways when you're talking about the Covered California program. You have individuals that can take an exemption on their federal return. And if you can go back to the previous slide there, John. There are exemptions that you can take on your California return, and that would be those exemptions that are listed at the very bottom of the screen here. When you're talking about income below a certain threshold, you're talking about health coverage considered unaffordable, things like that. So these are modeled after what we saw a number of years ago on the federal side of the house. And so we have short gap coverage, which means if they don't have insurance for a month or so, all the way up to 3 months, they're still considered having health coverage. Again, this is one of those exemptions. You also have individuals who are enrolled in certain types of what are called limited or restricted scope Medi-Cal. So again, just different types of exemptions. These are listed in your publication, your Franchise Tax Board publication 5130, and you may encounter these from time to time. What I've seen at the VITA site, typically individuals who cannot get health insurance through their employer, or through Medicaid, or they can't buy it on the open market, a lot of them will qualify for Medi-Cal. And I have not been in Medi-Cal, so if you have been in Medi-Cal, certainly you can share information with other VITA volunteers. But as I understand it, it's a program that the taxpayers paid for, and it's geared for individuals who are low income, who cannot afford health insurance. But again, that's one of those exemptions. All right, I think that's all I need to cover there. Okay, how about the next slide? And then again, this is kind of modeled on the federal one that we used to know about. So these are exemptions that are processed by Covered California. And so if you're in Covered California, you can get the exemptions. There'll be a number that'll be generated for you. And then, of course, the taxpayer would bring that exemption certificate number then to the VITA site. We'd enter that. But this is general hardship, affordability hardship, which means you can't afford it. If you're going to pay for your insurance, then you're not going to be able to pay for food and or rent, something like that. And there's a thing called the religious exemption. I haven't seen that. It certainly exists. And so if someone wants a religious exemption, they would do that through Covered California. But again, these are things that the taxpayer has to initiate through Covered California. We do not do this. We being the VITA site, this is something that the taxpayer would initiate, and then they would come with that exemption number to our site. Because again, if you're a California resident, the rule is you have to have health insurance. If you do not have health insurance, you have to have an exemption. And if you don't have an exemption that you can claim either on your tax return or through Covered California, then you have to pay that individual share responsibility penalty. Okay, next slide. Okay, so when we talk about the healthcare exemptions, we talked about them. Two ways to get it, one on the return, one through Covered California. And then the form 3853 is built into the California software. And so again, if someone needs an exemption, then we'll go ahead and go into the software and indicate that. When you're talking about the penalty we're going to show you on a subsequent slide. The penalty, it starts to add up. Quite frankly, I can't remember if we've had a lot of people where we set them up for a penalty, but what you're trying to do, you're trying to look for an exemption, because the penalty, again, starts to add up, starts to become expensive for the taxpayer. I think that's about it for this slide. Next slide. Okay, so again, we've talked about the penalty. This will happen from time to time. It's not the norm. It's really the exception, because again, we're going to look for that exemption if we can find it for the taxpayer. And that's one of those things we're going to go back and forth and have the discussion. But when you're talking about the total amount of the penalty, it's either based on a flat amount or a percentage of household income. And so you can see that flat amount is $825 per adult. So if you got a married couple and they've got a couple of kids, it starts to get expensive, or they would default to that 2.5%. But the takeaway here is when someone says, I don't have health insurance, and we're going to have that detailed conversation, we're going to determine, okay, why do you not have health insurance? And a lot of times it'll probably be, I can't afford it. I cannot afford it. So we're going to have that discussion. We're going to get into that Franchise Tax Board publication 5130. And then in some cases, that might be a little bit longer of a conversation, because again, I do not want to set anybody up for a penalty if they can get one of those exemptions on the tax return. And again, typically it's going to be, I can't afford it. Okay, I think that's about all we need to say there. How about the next slide? These are some tips from TaxSlayer. It's kind of a busy slide. I think probably the way to do it, we're going to go through a California return, and we're gonna go ahead and show you what you want to do on that form 3853, and you will see what is called Part 3 on the form itself. But we're going to show you what you should do. Again, looking for that exemption if one can be found. And then here's another thing. This is both federal and state. When you're talking about a particular form, you have the form, and then you have instructions to the form. And the instructions are going to be a treasure trove of information for that particular form. And so the instructions to the 3853, which to my knowledge have not been published for tax year 2022, they will be helpful in completing the return and making sure if they have to pay this penalty, then the penalty is calculated correctly. Okay, next slide. Okay, so other things, we talked about that exemption certificate number. What that is the taxpayer, this is the taxpayer's responsibility. So if they have to get an exemption through Covered California, which is also known as the marketplace, they would enter information in Covered California, and they would be issued, or an exemption certificate number would be given to them in Covered California. And then they would bring that to our site, and we would enter that into the software if we need to. Again, that's for individuals requesting an exemption under Covered California. And I think that's all I want to say on that one. Okay, here's some things that most of us are aware of. When you're talking about the filing date, it's generally going to be April 15th. If you look at your calendar, what happens is California, they will piggyback, or they will conform with federal tax law. Sometimes you've got April 15th, which lands on a Saturday, or lands on a Sunday, or it lands on a federal holiday. And if you're thinking, well, what kind of federal holiday is that? Well, there's a thing called Emancipation Day in the District of Columbia, and that's where the IRS is headquartered. And so if Emancipation Day falls on the 15th, then you're going to go to the next business day. And business days, of course, are defined as non-holiday, Monday through Friday, not the weekend. And so, kind of take this a little bit further. Sometimes I tell people that their refund most likely will be deposited within like 5 to 7 business days. Sometimes, especially, and I'm not poking fun at young people, I was a young person once. Some people have no idea what a business day is. So you just tell them it's usually Monday through Friday, and it's not a holiday. So you have to exclude weekends. So if you say 5 to 7 business days, you're probably talking approximately 10 calendar days. And so again, back to our due date, it's going to be due on the 18th. Now, this is important. We are not going to be filing returns on the 18th. Our last filing session is before the 18th. We're going to get things in the can because we're not going to be running to the last moment. And there's no exceptions to that. We're not going to open up, and we're not going to do things the day before. We're just not going to do that. So you're going to see those filing days at our VITA site, I should say, our VITA prep days at the VITA site, and we're going to stick to them. We're not going to extend them, and we're not going to prepare a bunch of returns on the 17th of April and try to submit them. And I do recognize, if you've been an ERO, I do recognize there's an additional period, but again, we're going to get these returns prepared and submitted before the 18th. That's how we're going to do business. And then for the automatic extension, you do have taxpayers who get an automatic extension. And for the state of California, it's a paperless extension. What that means is they have to pay the tax that they owe to the state of California. They have to pay any penalties that they owe. They have to pay the interest. But as far as filing a return, they can file it all the way through the 16th of October. Now, as far as late filing, that's something that we're not going to do, because our VITA site, we're going to roll up the sidewalk, we're going to shut down the computers, everything's going to go away, and we're not going to be in operation after essentially after the 15th of April. There are VITA sites which are open after the 15th of April. And what we can do is we can provide you with a short list of those sites that are open. Some of them are open all year. But again, the takeaway is when they come to the site, we're going to file the return, and we're going to get it filed well before the 18th of April. And that's both the federal and the state return. Okay, next slide. Okay, we all know this. I mean, if you've been to any one of these sessions, you know that there are certain filing statuses, and this is the rule. And we may see an exception once in a blue moon, but generally, whatever the filing status that appears on the federal return will be the filing status that will appear on the California return. That's going to be the general rule. And then the only reason I show this slide is, again, there's a new name for the qualifying widower with dependent child. It's now called qualifying surviving spouse. And that's both the federal new name and the state new name. Again, qualifying surviving spouse. So you'll see that. You'll also see that on the form itself. And some people may get confused and you just tell them, hey, it used to be called the stewardess, and now we call them a flight attendant. It used to be called a qualifying widower with dependent child. Now it's called a qualifying surviving spouse. And so that's a new name. All right, next slide. Additional filing requirements. So what that means is we have the general rule based on gross income and AGI, and of course, age. There's things in California, a lot of the stuff is outside the scope of VITA, but sometimes you'll have someone who has a lump sum distribution and there's a tax. So for example, now this may not be a good idea, but I recognize some people have to do it. I see this a lot. Unfortunately, I see it too much where an individual is in their late 20s, 30s, maybe 40s, and they either want their money from their 401k, which is a tax deferred savings vehicle, or they need their money. And so what they do is they take a distribution and they end up with some type of withholding from the federal government. A lot of times there's no withholding from the state government, but when they get that distribution, and it's an early distribution, and generally that's age 59 and a half or younger, then they have to pay what is called an additional tax. And the additional tax is 10% on the federal side of the house, 2.5% on the state side of the house. And so that's a requirement where even though they don't reach that gross income requirement for California, because they have that 2.5% tax they have to pay to California on an early distribution, they're required to file a tax return. And again, unfortunately, I see that a lot. I saw that a lot during COVID. Of course, there was some legislation in place that individuals didn't have to pay a penalty on an early distribution. But again, if you know anything about time value of money, if you know anything about opportunity costs, if you know anything about behavior, human behavior, when you stick a bunch of money in someone's pocket, it's just, in my estimation, it's just not a good idea unless you absolutely need the money, which means you're going to be living on the streets, and that's why you got to take that distribution. Every person I bump into in their 30s and 40s, late 20s, and they're thinking about taking a distribution from their 401k early, I tell them, don't do it. Find the money somewhere else legally. And that way you're not going to lose out on opportunity. You're not going to pay the penalty. And keep in mind, when you take a distribution, you're paying federal income tax on the distribution for a tax deferred savings program. You're paying state income tax. You're paying a federal penalty of 10%, and you're paying a state penalty of 2.5%. And so when you do the math, you're looking at, it could be 30, it could be 35, it could be 40, it could be 45% of the distribution. And I always tell people that's probably the most expensive money you're going to bump into. But again, at the end of the day, there is a penalty that's assessed unless the taxpayer can take one of these exceptions regarding the penalty. And then there's other things. The recapture taxes, we don't do that in VITA. Alternative amendment tax, we don't do that in VITA. And so the one that you're going to spend time with will be that 2.5% penalty for the state of California on an early distribution. And there are exceptions to that. But generally 59 and a half, if they're under, they're going to get penalized. Next slide. Okay, the in-home supportive services, I've seen this, I've seen it over the years. I've seen a lot of it, and maybe not so much in recent days, but it still exists. Sometimes we refer to these payments as the Roseville, California W-2s. And apparently there's some type of state government office either near Roseville, California, that would issue these W-2s. So what this boils down to is you have individuals who are typically, they are assisting a loved one. It could be a mom or a dad. It could be a brother, a sister. It could be a daughter or a son. And that individual they're assisting has some type of, usually some type of disability. Could be physical, could be mental, could be both. And so what happens is if they qualify, those payments that are made by the state of California, a lot of times those payments are not considered part of gross income. And I list the Internal Revenue Code section. We had a discussion about this about 4 or 5 years ago, and it really boils down to, I think they call it a social policy. And so again, state of California, they conform to that. So that means the state of California is not going to tax certain individuals who are receiving compensation for caring for a loved one. And again, there are certain exceptions to that, but that's generally what you're going to see. And so what I've seen in the past is when you receive a W-2, you're going to see the taxable amount, both the federal side of the house and the state side of the house. So I would say you want to key it into the software as you see it on the W-2. And again, I know they call them different things, but it's IHSS. Okay. Next slide. Okay, this is something that it's not super difficult. Most of us know this because most of us, we definitely own capital assets. And so you're going to bump into people who have sold certain things that they've owned. And then when they sell them, they have to calculate a gain. And so when you're talking about a capital asset, typically you're talking about stocks, bonds. It could be their personal residence. It could be their personal automobile. It could be their personal refrigerator. But for us, it's usually the house, the car, and then of course shares in some type of corporation or bonds that have been purchased. Typically corporate bonds. But anyway, and of course mutual fund shares too. That's important. If you're in a mutual fund, you own shares in a mutual fund company. The mutual fund company, they own shares in other corporations. So when you sell your mutual fund shares, that's a capital asset. And so we know when you sell a capital asset, you got to calculate, do you have a gain or do you have a loss? If you have a gain, you're going to report that on your federal return. And then we know on the federal return, the software is going to determine whether or not it's a short-term or long-term gain based on the period that it was held. If it's held for over a year, it being a capital asset over a year, then your software is going to calculate a preferential rate, which is a lower rate than ordinary gains. And for our demographics in the VITA program, you will sometimes, and I've seen this before, you'll see an individual, most of their financial activity is selling long-term capital assets. And in some cases, they owe little or nothing in federal income tax. And you'll see that from time to time, again, based on that preferential rate. Okay, so for the state of California just taxes it at ordinary rates. But on your federal return, you're going to get that preferential treatment for, again, long-term gains. You're going to see people who will sell capital assets and they can't deduct the loss. So for example, if you have a house, and this happens even in this day and age, and even in Southern California, Orange County, people will sell their primary residence and you will see them have a capital loss. It is possible. And they cannot deduct the capital loss on their return. But for a lot of people selling their homes, they're going to enjoy what is called a capital gain. They're going to take that exclusion that we talked about. That exclusion is either $500,000 or $250,000, depending on their filing status. And so the takeaway here is your software does all of this for you, which is a great thing. And California simply just taxes the gain because California, they don't conform to that preferential rate for long term. And then here's the takeaway, and we've seen this if you've been involved in VITA before. Not all the time, but the vast majority of time when people dispose of a capital asset, they're going to have what is called an IRS Form 1099-B as in Bravo. And what that means is it's a brokerage statement. And as I said before, I'm not the smartest guy in the world, but I've done taxes for about 35, 36 years. So I know a little bit about taxes. And I have literally seen every type of 1099-B that you can think of. And I actually have looked at 1099-Bs before. And again, I know a little bit about taxes. I'm fairly educated. I'm not as smart as John. He's got a PhD, but I get confused sometimes with the 1099-B. They're like people. They're all different. And so I have literally reached out to brokerage houses and say, look, I'm reading your document. I don't understand it. Explain it to me. Now, sometimes you may have to do that. The vast majority of the time, your 1099-B will speak for itself. And then what I do when I look at an information return, if I don't understand it, I will look at the taxpayer eyeball to eyeball and say, okay, I've read this. What does this explain to me? What does it explain to you? So don't be shy about that, but generally they will speak for themselves. And you're looking for that brokerage statement, and they're all going to be different. They're all going to be different. So here's a couple of things you want to consider about capital gains. You have individuals, like for example, I'll use me. I've got a personal finance guy, and I pay investment fees to him to manage one of my accounts. And so those investment fees on my federal return are no longer deductible. And that's that law that passed back in late 2017. So you might have some management fees or investment fees you cannot deduct on your federal return, but you can deduct on your itemized returns on your California return. So you are going to see that. You'll have people with investment fees. And again, when you're looking at a brokerage statement, if you can't see that investment fee, if it doesn't pop up and bite you on the nose, then it probably begs the question. You ask the VITA client, do you pay any investment fees? And if you do, where's it shown on this 1099-B, or how much do you pay? And again, you can take that on the California itemized deductions. And then reference primary residence. We don't see a lot of people selling their homes and it goes through the VITA site. You see it from time to time. And typically what happens when you sell the home, then you're going to enjoy a capital gain. And the VITA site, we can help you with the sale of a residence. Some of the time, sometimes we can't. It depends on facts and circumstances. But you will find the sale of a primary residence, if the taxpayer has all of the information, this is not a bridge too far. It can be done pretty quick. But again, the taxpayer has to have all the information. Let's see. And then, yeah, the very bottom, you can see it kind of cut off there. California doesn't conform. So there's certain things on that 2% of miscellaneous AGI that the federal government has done away with for the time being that you can take on your California return. Let's see. I think that's about it for this one. And again, mutual fund shares, when you sell your mutual fund, that is a capital asset. All right, John, any questions? I know this can get real busy when you talk about capital assets.
No, I don't think there's any questions.
Okay. All right. And again, I would just mention, I get that 1099-B, I look at it, and usually it tells the story. It usually tells a story. Sometimes people will not have the 1099-B pertaining to what is called the cost or the basis of the asset. And then what I tell them, I say, you know something, you can literally go online to a reputable site or sites, and you can look up the cost of stock that was sold back in 1911 or 1951. You can find basis of stock out there. And sometimes it takes a little bit of time on reputable sites. Sometimes you have to pay a subscription fee, but you can find the cost of that Winnebago stock that person bought back in 1967, even though they may no longer have the cost of the stock, but they know they got shares they bought in 1967, they recently sold, and you'll be able to find, or they'll be able to find the basis of that. And of course, if you get to a situation like, gee whiz, what do I do? You just bounce it up to someone, the assistant site coordinator, the training coordinator, myself, and then we'll find a way to help the taxpayer. And sometimes that's basically giving the taxpayer an assignment. Okay, go home, look it up, because maybe we don't have 3 hours to go to those reputable sites to find the cost of something from 45 or 50 years ago. Next slide. More of the gain of the sale of personal residence. And this is something, again, if you have the data, it's really not that hard to do. But the big thing, as I always tell people, when you sell a home, a lot of people do not have all of the information they need pertaining to the cost of their home. So for example, I've owned my home for about 25 years. I bought it. I know what I paid for it. It's on the settlement statement. I still have the settlement statement. I've also done what are called capital improvements. And so, for example, I put in a concrete patio in the back where concrete patio didn't exist. And so I don't know what it was, 10, 15, 20,000 bucks. I dumped that patio in. I installed it. So what that means is that's a capital improvement. And those capital improvements then are included into the cost of the property. And now we have what is called adjusted basis. And so that's what you're going to get from your taxpayer. And sometimes the taxpayer has to go through their records, and then you want to be able to differentiate between repairs and those capital improvements. I'll give you an example of a repair. I had a front door, and my son, he's pretty strong, so he's manhandling it one day, and he breaks the lock. So I call a locksmith. Guy comes out, cost me $250 to repair my door. That's a repair. Broken windows, those would be repairs. You might have someone who gets a permit and they build an extension on their home, and that would be a capital improvement. So all of those would go into what is called the adjusted basis, and we would use that and compare that to the sales price, and they would come up with what is called the gain. Most of the time, people will have a gain, not all the time, but most of the time. And then, of course, the software is going to calculate the exclusion, and the exclusion for married filing joint folks is $500,000 up to 500, and for single folks up to 250. In the VITA program, we don't do partial exclusions. And so what that means is if someone moved because they got a new job, then they would be eligible for a partial exclusion. We don't do that in VITA. And then this is something that, in addition to those settlement statements, in addition to the documents for the cost and the capital improvement, your California Form 593 will be issued to taxpayers in escrow, and that's real estate withholding. And sometimes there is federal and or state withholding, and that would be reflected on the 593. It will also be reflected on that settlement statement. And so when you go through escrow, you're going to be issued a settlement statement when you purchase property and a settlement statement when you dispose of property. And so I always ask for, hey, where are your settlement statements? Do you have your Form 593? And tell me about all of your capital expenditures. Then you want to define capital expenditures, usually a big ticket item. And then sometimes it's an assignment for the taxpayer to go home. Sometimes it's not a problem. I've written it all down on this piece of paper. Here it is. And then we can go through the sale of a personal residence and determine the gain, which appears on the Schedule D as in Delta. And then just one item for California, talking about conformity. I'll read that second paragraph. It says, for California folks who served in the Peace Corps during a 5-year period ending on the date of sale, they can reduce that 2-year period. This is on their California gain by the period of service not to exceed 18 months. I don't think we're going to see that, but if someone's in the Peace Corps, what that means is they've signed up, they've done their time. I think usually it's a 2-year stint in the Peace Corps, and then they are essentially discharged. And so they'll have a document for their discharge papers for their time in the Peace Corps. Okay, any questions about this?
Hey, Jared, we have one question about you mentioned reputable sites. Are there any that you know of, specific ones, or?
Let's see, doing this from memory, it's been a while since I've gone through it. Let's see, can I think of a site? I can probably look one up on the break. Fidelity is one that I've used in the past. JP Morgan, that's something I've used in the past. Those are the ones that come to mind right now. Okay, then next slide, please. Okay, the Schedule K1, when you have an individual come to the site, they're going to have sometimes that Schedule K1. And all that means it's an information return. And you have different types of entities. And the ones typically that you're going to see an individual who's in some type of partnership. And what that means is they're going to be issued a K1 because they happen to be a partner. And all partners will be issued a K1, or maybe they are a shareholder in an S corporation. An S corporation, it is a corporation. There are different rules that apply to an S corporation as opposed to a C corporation. And then what happened is, as a shareholder in an S corporation, you're issued a K1, that information return, and that has what is called pass-through information, which means the S corporation, the income or the loss is going to be allocated to the shareholders. And so if you are a sole shareholder of an S corporation, meaning the only shareholder, then all of the loss or all of the gain is going to go through to your Form 1040. And that loss or gain will be reflected on a Schedule K1. And then, of course, if you have an estate or a trust, and I'm not an estate or a trust guy, I've seen them before, but sometimes you have a K1 that's issued to a beneficiary. And so again, if you have a K1, it's in the publication 4012, there's a limited scope. And if you look at the bottom of the screen, those are the items that appear on a K1 that we will help the taxpayer out with. And that means interest and dividend income, qualified dividends, which are taxed at a lower rate, gains. You have what are called short-term and long-term gains, and then different types of, we talked about tax exempt interest. There's certain interest that's exempt from taxation, and then royalty income. And that could be from an oil or a gas well. It could be from other things. But again, those are the things that we're going to look at. We're going to pluck off those items on the Schedule K1. We're going to enter it into the software, and then the software will do its magic. And then sometimes I think I mentioned this before, you're going to get an occasional taxpayer, and they're going to ask you, well, why don't you guys do other types of returns like an S corporation or a estate or a trust return? Well, the answer is very simple. We are not trained to do those returns. Those are very complex returns. Our program is a basic tax preparation program, and we prepare basic tax returns. And we're not trained to do all that other stuff, so we don't do it. And again, sometimes it begs the question. People say, well, where do I go? I refer them to a tax professional society, and they can go to that website and they can find a tax preparer. And then sometimes they'll ask you, what do they charge? My answer would be, I don't know. You got to ask them. We have nothing to do with that, but that's where you want to go. Again, our charter is small. We have a small garden, if you will, and it's basic tax returns. But this is an item from complex returns that we can help them out. But again, only looking at the K1 and only looking at those items that are shown below. And in your publication 4012, if you get a K1, open up the publication 4012, go to the K1 section, and it shows you where to go in the software to make those entries to add interest or dividend income or whatever type of income you have. Okay, next slide. Okay, gambling winnings. And again, I mentioned this before. I see this all the time. I can't explain it, but a lot of people gamble. And so there's different types of games in California. The only one I'm familiar with is Super Lotto. I think I played that once or twice, but there's different types of lottery winnings. If you win a California lottery, it's not taxed by California, which is a great thing on your California return. Now, of course, on the federal return, it's going to be taxed. You simply have to go as a preparer. You have to go into the California return, which we're going to show you, and you have to make entries and say, okay, this is the amount not subject to California taxation. And let's see. And then gambling losses. Gambling losses are reported up to winnings on a federal return. But if you have California lottery losses, they're not deducted because you can't have your cake and eat it too. In California, you're not going to report your California winnings And so it kind of makes sense. You can't report your California losses, your lottery losses. And so that's the thing for gambling in California. Next slide. And we already talked a little bit about the itemized deductions. When you hear the term itemized deductions, this is going to be on the Schedule A for the federal return. But the tax law for the federal government changed a few years ago, where those miscellaneous expenses, a lot of miscellaneous expenses went away. So, for example, if you had tax preparation fees at one time, you could deduct them on your Schedule A itemized deductions on your federal return. You can't do that anymore. But on your California return, if you itemize on California, you can take that tax prep fee. And of course, in the VITA program, we don't charge, obviously, tax prep fees. Or sometimes you have a safe deposit box. Like when I was a young guy, I used to have a safe deposit box. I used to keep all my legal documents in there. And then at one time I had gold bullion, silver bullion, and some rare coins. So I had all that stuff in my safe deposit box. Well, at one time I could deduct that on my federal return, no longer, but you can still deduct that on your California return. And then there's a thing called paying monies to collect income or to produce income. You can't do that on your federal return anymore, but you can do it on your state return if you itemize on your state return. And again, if you're talking to someone who's an investor, usually there'll be the investment expense that will be reflected on their brokerage statements. If it's not, I just ask them straight away, what do you pay for your investment expenses? And there's going to be usually some type of document. Maybe like I have a client, she receives a separate letter from her broker, and it says, "Dear client, here's all your investments." And she also gets a 1099-B, but here's all your investments. And here is the investment fee that we are charging you this year. Please enclose a check. And so you may see that. Okay, how about the next slide? Okay, then the foster youth tax credit, if this existed last year, I didn't see it. According to the rules that I looked up, it started in January of this year. And so this is the foster youth tax credit, and the maximum credit's over $1,000 if you qualify. But of course, there are income limitations, and this is based on your California AGI. So that means if your AGI is more than $30,000 for California, you're not going to get this. And then here are the rules for the credit. You have to be in foster care, 13 or older. You got to be between 18 and 25, and you have to be eligible to claim California EITC. In order to get California EITC, you have to either be a wage earner or you have to be self-employed, and of course, obviously, low to moderate income. And so this is a credit that we will probably see a little bit of. And again, I think this is either a new or a newer credit. So this is a good thing for especially young adults, the foster youth tax credit. And this does not replace any credit. Those other credits that we learned about, Cal EITC, the young tax credit thing, that's still around, but this is just another credit that is available. Next slide. Okay, so what we're going to do, it's a little bit early, but let's go ahead and take a break, and then we're going to jump into, and what I want to do is, and I recognize that the tax return for California is not loaded for 2022, but we want to at least look at the 2022 software. So we're going to jump into one return, a single guy, an older guy. We're going to look at his 2022 federal return, and then we're going to jump into a 2021 return where we're going to go through covered California for a married couple. So let's take, John, let's take 10 minutes. I've got 11 o'clock. Let's come back at 11:10 and then jump into the. Okay, welcome back. This is Jerry again. Fred Ramos wants to address our volunteers. He's got some information he wants to put out. So Fred, you have the floor.
Okay, I didn't realize I'm going to do it now. But anyway, there's our things to do. Would like to call on to the past, present, and future volunteers particularly the St. Killian volunteer, please reconfirm or update your contact information to Emily, CC, Jerry, and me, because we're getting more link disconnection here, so that we want to make sure items of concern that we need to pass on later on when we disband here, like link and learn information, certification, surveys, needing laptops, particularly the new t-shirts that will be given out this year. We need sizes for all volunteers to input and give us the information. And lastly is how we can assist you, or how we can help you, like needing any mentors, body system, and so forth. Additionally, for those who are volunteers, particularly the new ones, we need savvy ITs, professional ITs, or who doesn't need to be really professional, but anyone who understands ITs, we need assisting ITs to help us as well. And in addition, there will be more information needed when we promulgate the process, if we are going to do virtual drop-off, or if we're going to do in-house appointment. So we need those who are sturdy, who can assist us preparing the table, chairs, and shelves that are close by St. Killian to assist us. So those are items of concern we need to address and ensure any volunteers willing to help us there. Please let us know, and thank you very much. That's all I have. Jerry, the floor is yours.
Hey, thank you, Fred. Hey, just real quick, if you've got your calendars in front of you, this is how we're going to do business on the very last tax preparation session that we have. That last tax preparation session will be Saturday, April 15th. And what's going to happen is when taxpayers come in, we're going to tell them that we're at the end of the season. We're going to go ahead and prepare the returns. There will be no drop off on the 15th. There will be pickup, which means if they've had the return completed that week, they're going to sign the 8879, and we're going to e-file the return shortly thereafter. But on the 15th, we're going to complete their return, and we're going to tell everybody as they leave the church that if something comes up and we cannot electronically file the return because something's happened, if we can't perfect it in the next day or two, then we're going to inform the taxpayer they need to make a copy of the return that we've given them and mail it into the IRS and the franchise tax board. And that's how we're going to do operations the last session of the season, which is the 15th of April. All right. And then any other questions, John, before we get started?
No, I guess there's just a tip that someone had in Excel. If you have Microsoft 365, there's a function stock history. You can provide history for any investment, the stock symbol. That's interesting.
Okay,
Tip,
good,
Bob.
good. All right.
And then and Della wanted to know when's the first day of tax preparation.
The first day of tax preparation will be Saturday, January 28th. And so if you're all ready to go, you can show up at the St. Killian's. We'll be on the second floor, and we'll put everybody to work. We'll have assignments. Emily, John, the leadership team, myself will all be there, and we'll announce the time to show up. You probably want to get there at least a half an hour early. I'll be there probably about 8:30. We start prep at I think we start prep at 9. So yeah, I'll probably be there about 8 o'clock. All right.
Okay.
Okay.
What do you want to show, Jerry? What?
John, let's do this before we get into the actual returns. Can you go ahead and forward to the next slide? There's a conclusion slide. We want to get that out. Oh, here we go. So your volunteer agreement, that's a 13615, which will be populated in Link and Learn. That'll have all of your certifications. Once you complete that, you can email it to Jerry at that email address. That's my phone number. Or if you've got Emily, Emily's the assistant site coordinator, you can email it to her. If for some reason you don't have it, when you show up on the 18th, before you start working, show up with a copy of your 13615 along with some type of identification. And that way we'll sign off on it and you'll be ready to work. Here are the mark your calendars. The Zoom session I mentioned is Saturday, the 14th. We'll have that recorded. It'll be 10 o'clock. The focus will be tax preparation, and that'll be a VITA representative from the Franchise Tax Board in California. And then right now our prep, we're looking at Saturdays, and it will be from 9 to 1, which means the team that needs to set up is going to get there a little earlier, but all the computers together, most likely about an hour early. And then if you are a preparer, you want to show up at least 20, 30 minutes early. So that way you can get your assignment, you can get to know some people, and then fire up your computer and get ready to go. And then, of course, our preparation will be on Saturdays. Right now it's Saturdays, 28th through the 15th on that second floor. And then any additional times and dates will be published. I'll be conferring with the team, and there might be additional dates that pop up, and those will be announced in advance and for everybody to know. Okay. Any
Jerry.
questions about these administrative notes?
Jerry,
Yes, Fred.
yeah, the FTB publication and forms have been ordered. So they should be coming in before January 14 for distribution to our volunteers. As well as we have those training manuals still available at St. Killian front office for those who have not done so.
Fred, you're talking about the publication 4012.
Yes, yes.
Okay.
Yeah. It's-
Oh,
Yeah,
for
yeah,
the St.
and
Killian
if you
volunteers.
are newer, or you're one of those people that love electronic items, all of these documents that we speak of, both federal and state, they either are going to be published or will be published before the tax season begins. So you're going to be in good shape. There'll be no shortage of electronic documents. If you're a hard copy guy, like for example, that publication 4012, I use it all the time. I spill coffee on it, I write on it. And if you're that type of guy or gal, then you're going to be able to get the pub 4012. But again, all of these things are available electronically.
Okay, Jerry, there's a couple questions. One is, how long will the Franchise Tax Board Zoom call last from, I guess it's starting at 10?
Yeah,
You know
that
how
Zoom call should last no more than 2 hours. I'm sure she's going to be done by noon, easy.
Okay,
That is
and
right.
then,
That is right, Jerry. That's what happened last year.
okay, and then there's a question about your Coastline College class in January. Is it live? If so, what are the dates and times, or is it just recording?
The Coastline class starts on January 3rd. You do, of course, since it's a college, you've got to register for the class. It's a 1-credit class. You don't have to buy any materials, but you do have to pay I think it's $46 for a credit hour at California community colleges. It will be all what is called online. We use what is called a Canvas learning management system. And then what we do is we have recorded sessions. Some of them, well, let me restate that. We do have Zoom sessions. Some of them are recorded, and then some of them are live. And yes, we do record those live ones. So if you want to sign up for that class, you have the opportunity to certify the basic, the advanced, the military. And then we do have sessions where we talk about obviously California and federal tax law. We go into the software, the new software, both federal and state, and we navigate around there. And so if you want to do it, it's about a 3.5, almost 4-week course. And then at the very end, you will be certified at those 3 levels that I mentioned, basic, advanced, and military. And then hopefully, once you complete that, you'll volunteer at St. Killian's. And then if you want to, at Coastline Community College, our site is open on Fridays at Garden Grove from 10 a.m. until 1 p.m. So if you want to do both, in fact, we had Paul and his wife and Emily and some other folks take the class, and they volunteered both at the St. Killian's and at Coastline on Fridays.
Will the FTB Zoom session be the same Zoom ID as we're having today?
Oh, good question. I don't know that. If someone knows that, chime in. Otherwise, that will be sent out to all of our volunteers so they can access it. And Scott, was that from you?
Yes, that was.
Yeah.
Okay, so yeah, so I think the way it'll work, Scott, is Steve, our IT guy, he will provide the Zoom ID information so we can all log in and listen to the franchise tax board employee.
Great.
All right. Okay. If there's nothing else, and again, I just would encourage everybody to, make sure you contact Jerry and Emily and John, somebody in the leadership team. And if you can show up on the 28th, even if you don't want to do taxes, if you just want to show up and see what's going on, that's great. And that way we can figure out who's who in the zoo. We can make assignments. But if you can certify by the 28th, that's even better, which means you can start. And we do this at Coastline. I know St. Killian's also does it. We will sometimes take a new volunteer and match them at the same table with an experienced volunteer. And that's another great way to start building confidence, learning the system, learning the software, exchanging ideas. And then before you know it, you're off doing it on your own. And the last one here, again, if you're brand new to the VITA program, this website, you're going to use it to access Link and Learn. You can certify on Link and Learn, and then you can utilize that free tax preparation software to practice, to certify. The practice lab does not allow you to prepare returns so you can e-file them. It doesn't happen. It's not hooked up to the big computer in the sky. Okay, with that, John, if you can transition to the Morgan return, let's introduce them to the 2022 return.
This is the more Moscow.
Yeah, you want to go to the practice lab.
Oh, practice lab. Okay. Are you seeing?
Before you do anything, John, just real quick, this is your landing page for the practice lab. And I do understand we had one of the volunteers said some things are not updated. I understand that it's a work in progress, but this particular landing page, you should spend, if you're going to spend time on it, and John, if you cursor down, there's two things toward the bottom that you'd spend time on. You'd spend on preparing a return. Those are your tutorials, which I think have some added benefit. I've used them in the past, and they're short tutorials showing you how to use the software. And then off to the right, you have those practice returns with the check figures. Do not prepare a married filing separate because we don't do it in VITA. And it has, if you're, what's the word, ambitious, and you plan on certifying at other levels, then there are other levels there, international and military. At present, we're not doing that at St. Killian's. We're only doing advanced returns at St. Killian's. But again, these are practice returns, giving you additional opportunities to work with the software. Okay, John's going to go up to that big blue tab toward the top. He's going to hit Practice Lab. And then the
Oh gosh, I have to go this again.
password is Train Pro Web, all one word, all uppercase.
Oh gee, Jerry, it looks like I got to log you in again. Let me.
Okay, then John's going to log in here. Now, of course, if you're brand new and you haven't signed up for a use of the practice lab, you would create an account. You'd follow the prompts, enter the data that you're aware of. And then once you establish an account, you can sign in to use the practice lab. Okay, and so what John has here, he's got the 2022 And this is something you want to keep in mind. This is confused me at least 100 times. I'll be going into the software and I'll have the wrong tax year. And if you know anything about pairs, sometimes you're preparing a return from 3 or 4 years ago. Now, in our program, we will do past year returns, but our focus is on the current year, which is 2022. And if John goes into the upper right-hand corner, there's a tab that says change the tax year. And you can see in the practice lab, it gives you 2 choices right now. In the live or real software, we should be able to go back a number of years, certainly more than 1 year. And then on the extreme left-hand side of the screen, it has a lot of information to include the blog, release notes, IRS website, all sorts of information pertaining to the practice lab. And so as you go through the season, chances are you'll click on that and you'll read some updates. And here's another thing, what we do in our VITA site, when you show up every session, there will be updates to the tax law, i.e. perhaps maybe a regulation or maybe a notice or a procedure. And there may be some updates to the program administrative notes, and there may be updates to the software. So what we'll do is we'll have a very short briefing, and we'll go ahead and explain that to all of the volunteers. We'll have a question and answer period. So that way to keep you up to date, and so you feel comfortable that you're doing current stuff. Okay, so we have the client search. I've already entered this client into the software. Now, John is not going to do this. He's just going to show you the button. He's not going to press on it. When you want to start a new 2022 return, you would go to the tab that says Start a Return, go to the right-hand side, and there's a gray button that says Select. Once you click on that, it'll bring up the software. You'll enter the, obviously, the Social Security number of the taxpayer, and then you'll follow the prompts and enter all the data. And if you're brand new to VITA, you're going to find, as I was talking to one of our volunteers earlier, the first time you do it, okay, like anything, you know, you're kind of flopping around, maybe it's a little clumsy, but you're going to have people that literally will be within arm's reach to say, oh, click here, click there. And after a few returns, you're going to feel comfortable doing this. You may not master the material, but you're going to get pretty good after a few returns. Okay, so John is going to click on Client Search. I've already entered the data. And he's going to open up. This is the laundry list of all of our preparers. And let's see. So John will select John Morgan. And then we're going to take this from the top, as they say in Hollywood. So he's going to go to the extreme left of the screen, and he's going to go to the very top that says Basic Information. And we're going to start with filing status. And most people are going to get filing status. It's not going to be an issue. Probably the time that you'll maybe do a little reading is when you have someone who comes in and says, yeah, I've got a kid or two and my spouse is gone for whatever reason. And most likely they'll qualify for head of household. I would encourage you to use what is called the decision tree in the publication 4012. And just remember, we don't do married filing separate. I can't tell you how many times the VITA clients have asked me, hey, can you do this? And I tell them, well, yeah, I can do it. I do this professionally every day. But in the VITA program, no. Go out and find yourself a paid professional. And I don't know what they're going to charge you. And yeah, you know, you want to use the caring voice. You don't want to bark at them, but we don't do it. It's non-negotiable. We don't do married filing separate. And then you can see that new designation, qualified surviving spouse. And so you want to make that determination. And in some cases, an individual will qualify for both filings. It's 2 different filing statuses. You'll pick the one that's most advantageous. And yeah, we talked about the wizard before, that filing status wizard, just another tool to help you out, because there's a lot of things in the tax world, and the more tools you have, typically you're going to be better off. But the publication 4012 is your go-to document. And then I always tell people the 4012 is your go-to document. Your next go-to document, other than that California one, the 5130, would be the IRS publication 17, and that would be the updated publication 17 when it's released. Okay, John or Yeah, John is going to hit the continue button. Okay, so the information, this is one of those, yes, of course. We do know that we're going to use the name that appears on the Social Security card. And we are going to ask people come in with a Social Security card or a document, and that would be from Social Security Administration typically, that has their social and their name. And then with that, we can prepare the return. But yeah, you want to collect that. And sometimes you have names, nicknames that are used, but we want to use the name per the Social Security card. And then toward the middle of the page, you can see all these various tabs. And the ones you'll probably spend some time with is if you have a taxpayer who's over 18 and they're going to a college full time. You might have taxpayers that are visually impaired, and that's according to the tax definition. And if they meet that definition, then they would be blind, which means there's an additional standard deduction. And then, yes, we do, unfortunately, we do have some taxpayers that come in for their one of their loved ones who's a decedent, could be a mom, could be a sister. And then we would indicate we have a deceased taxpayer. And then the other one where it says contribute $3, that simply means the taxpayer is issuing an order to the federal government. And the order is federal government, take $3 wherever you can find $3 and put it in this presidential election campaign. And then when you have the race in a couple years, if someone qualifies, they can get money from the federal government. You can ignore the combat zone. We don't do that at St. Killian's. If you are at Coastline College, we do prepare returns for military personnel, active duty and reserve, and we do that, but not at St. Killian's. John, if you can go ahead and just wiggle your cursor by the digital asset question where it says sold, exchanged, or gifted. Okay, digital assets. I'm not a digital asset guy, but this is what we do in VITA. We will not prepare a return for someone who has sold or disposed of digital assets, i.e. Bitcoin or something like that. We don't do that. Again, they'll have to seek out a paid professional. Now, if you purchase a digital asset and you're holding that digital asset, i.e. Bitcoin or something like that, cryptocurrency, that's fine. We can help you out, but we can't help you out if you sold it. We won't do that. And then we've mentioned this before. It's really good to mention it because if you ever get a letter sent to you in a different language, yeah, I mean, I've had that happen and I'm thinking, well, what do I do? I'm confused, maybe frustrated. Well, if a taxpayer is speaking a different language, they can ask the IRS to send them correspondence in their language, their native tongue. And that's that information toward the bottom. It says written communication. And this is really important in the VITA program. If you have a taxpayer who cannot clearly communicate in English, what we want to do, we want to figure what is their native tongue, and we can reach out and find someone who can speak Spanish, Tagalog, Mandarin Chinese, Farsi, something. We'll be able to find someone, Russian, whatever it is. We can find people to help us out. It may not be immediately, but let's figure out what language that person is speaking and try to help them out as best we can. Okay, we'll cursor down. Mailing address, usually not an issue. If someone wants to use a PO box, they can. But again, it will be an address that they're going to regularly check because sometimes the IRS will send you a letter or the Franchise Tax Board, and there's action required by you, the taxpayer. So we want to make sure we capture that recent address that the taxpayer has, along with their phone number. And yes, we do want an email address. Now the EROs, which is the electronic return originator, the individuals on a team that will electronically file returns, we will reach out to taxpayers to perfect returns. And that typically will be with the telephone number. And then if that doesn't work, then we're going to use the email. All right, we'll hit continue. And then and John's not going to click on this, he's just going to take his cursor. If you have a dependent or a qualifying person, we call them qualifying child or a qualifying relative. Typically, it's a minor person, meaning someone under 18. Then, of course, we're going to get the social form. We're going to go ahead and enter that into the software, and that usually will allow the taxpayer to enjoy one of the either refundable and or non-refundable credits. Another thing, this IRS protection PIN, we've seen that before, and all that means is someone has either taken your ID or you're in some type of compromising position as far as your ID. If you ask the IRS to send you what is called an identity protection personal identification number, which is called an IPPIN, then we can e-file your return for you. If they've taken your social, you can still paper file a return. You have to jump through a few steps, but you want to get that, and then we can help them electronically file. Okay, let's hit continue. And again, we're in our 2022 tax software. We're going to go to, in this case, this gentleman is a senior citizen and he doesn't have a job. He's retired. But what I want to do is I want to open up that 1099-G as in golf, just that second tab. And then this is something you want to kind of keep in mind when you're preparing returns. And we're talking now about that tax benefit rule. If someone has itemized on their federal return in 2021, and they've taken a full tax benefit of the state income tax that they have paid, then on their 2022 federal return, since they've taken that benefit on their federal return in 2021, then the state tax refund in 2022 on their federal return is going to be a fully taxable event. And if you, and John's going to go to that bypass state tax refund, he's going to wiggle his cursor, and that's where you would enter the data. Now, if you have a taxpayer who's taken a partial benefit, that's something, and we're not going to talk about right now, but you'll see that in the presentation from the franchise tax board. But you just got to remember, if you've itemized in that previous year, if they didn't itemize on the 2021 return, then that state tax refund is not taxable on their federal return. All right, we'll go ahead and hit continue or cancel and get out of this. Hit cancel, John. Okay, and let's go to the task at hand. Let's go to the next one that says 1099 INT.
Yeah.
That'd be that third tab, John.
Probably 12 o'clock.
Okay, so we're going to open up interest or dividend, and that'll be that tab that says edit. And you can see right here, I've made two entries, one for dividend income, one for interest income. And so when you hear the term dividend income, in fact, a lot of us probably earn it. Dividend would be from a corporation, or if you're a member of a mutual fund, you're a shareholder in a mutual fund, you can get dividend income. So in this case, we got some dividend income from a corporation, and we'll open that up, and that would be that blue pencil. And then when you talk about a corporation, if someone is enrolled in a dividend reinvestment program, that simply means that they have constructive receipt of the income, which means they're going to report it in the year they constructively received it, which means it'll be reflected on an IRS form 1099 DIV. So in this case, this is a corporation. We've got the EIN. We're going to enter it per the 1099 DIV, key it as we see it. And then you can see in box 1 alpha toward the middle of the page, we've entered ordinary dividends, and then we've entered qualified dividends per the 1099 DIV. And then here's something you'll see from time to time. You'll see a term called capital gains distributions. In this particular page, it's titled capital gain to Schedule D. A capital gains distribution is when you are a member of a regulated real estate investment organization or trust, or you're a shareholder in a mutual fund. And what happens is the mutual funds, for example, they'll sell their capital assets that they own in those various corporations, and then you'll have flow through down to you, the shareholder, and that's called a capital gains distribution. Again, referred to in this software as a capital gain. You simply key it as you see it from the 1099 DIV. Okay, let's go ahead and hit continue. And then we're going to open up the next one, interest income. And you do see people having interest income of maybe a couple thousand, maybe a couple hundred, it depends. In the VITA program, usually it'll be, you know, a modest amount, maybe 50 or $100. If you go to the lower, the middle section, you'll see where it says interest income box 1. That's right from the 1099 INT. And then this is something you may see on the 1099 INT, an early withdrawal penalty. An example of that would be you open up a bank account, you have a certificate of deposit, you sign contract, which means you're obligated to the bank's obligated to you. And then you decide to break the contract. You break the contract, you're going to get your principal back, but then the bank is going to withhold some of that interest, and that would be an early withdrawal penalty. And if you have that, you would key it as you see it, and that would be called an adjustment to income. And you may see that from time to time. And then also in box 4, although this guy doesn't have it, sometimes you have federal tax withheld. In fact, I think I got a 1099 INT last year for whatever reason. There was tax withheld. I can't remember, but anyway, if it is withheld, you'll enter that, and then that's part of tax withheld on the Form 1040 page 2. And then sometimes in box 6, where it says foreign tax withheld, if you have that amount, you'll enter that, and then chances are a foreign tax credit will be calculated on the return. All right, let's go ahead and hit continue. And then we're done with our dividend and interest income, so we'll hit continue. And we'll hit continue. And this is one way to do it. There's another way. You can go directly to the left-hand side, and you can enter your information. Okay, let's go to the next tab, which is a Form 1099 R's and Romeo. And so our choices are a 1099-R, which is retirement income. It could be a pensioner. It could be someone who has an early distribution from a 401k. That second tab is for the individuals who work for the railroad. They've got their own system. And then Social Security. And so what we're going to do is we're going to open up the 1099-R, that second tab. Let's see. Okay, I think I have him as a railroad guy. Okay, here we go. This is great. John, did we rehearse this? John, go ahead and open it up. Yeah, for instructional purposes. And so this is for instructional purposes, this is going to be a retirement. And I do recognize this for railroad retirement, but nonetheless, we'll get something out of it. And so here's the something that we're going to get out of it. We have an individual that has gross pay, gross retirement pension of $10,000. In some cases, the entire amount is going to be taxable. In other cases, the entire amount will not be taxable, only a portion of it. If you have a taxpayer that has a 1099, and it'll be a 1099-R, if you have someone who has a 1099-R and only a portion is taxable, then you have to go to what is called the simplified method. And so, John, can you hit where it says, do you need to calculate your taxable income? Check here. You see that? It's in light blue. And if you can click where it says calculate your taxable amount, can you click there? It says, do you need to calculate?
Oh, excuse me. No, I don't see it.
Yeah, it'll be
Right.
It'll be
Okay.
Yeah, there you go. It says click here for options. And if you click on simplified method worksheet, we want to show the crew this document. Okay, this tells you about the simplified qualification. We only work the simplified method, so we'll hit continue. And pretend this is a 1099-R for a pension. And so what happens is you're going to go to this screen when you have someone who has a pension, you know, from some work they've done, some corporation, some company, and they have made contributions to their pension plan. And I think I mentioned before, we had a guy at our site. He worked for some company for many, many years, and his return was prepared. He owed a truckload of money. We went into the return, and finally we asked him, do you have any contributions that you've made to your pension plan? It's called a basis in the plan. And he said, yes, I do. And it was multiple thousands of dollars. It was a lot of money. In fact, I think it was $80,000 for him. I said, okay, well, that makes a huge difference. And so he went and got his materials. He came back and we prepared this simplified method worksheet for him. And what we did, we identified all of these questions, and we answered all these questions, which pertain to when did the annuity start? When did the pension start? And what was your age? What was your wife age if you're filing a joint return? How many months you got your pension? And did you recover anything in a previous year? So you answer all of these based on their contributions to their pension. And then what happens is the software is going to kick out the taxable portion of their pension. You don't see this very often, but when you do, it can make a difference. And in the case of that guy who had $80,000 of basis in his pension, it made a significant difference. And so you want to make a mental or written note. Sometimes you're going to have to use this worksheet to calculate the taxable portion of someone's pension. Now, I do realize this is under the RRA thing, but this would be a regular pension. Okay, go ahead and hit cancel. And hit continue. And let's go ahead and just go through the rest of this. So in this case, the pension is the same as, the gross amount is the same as the tax amount, no issue there. But then we have federal income tax withheld. And sometimes you're going to have tax withheld, sometimes you're not. You're going to get this feedback from clients. They're going to say, well, why do I owe money? Then you look at the return and say, oh, that's easy. You had insufficient withholding on your tax. Well, what do I do? Well, if you don't want to get clobbered at the end of the year, you can have what is called additional withholding. Or in some cases, as a pensioner or as a wage earner, you can also make estimated tax payments. But in this case, he's got withholding of $10,000. And then if you cursor down, is that it? I think we're almost at the bottom.
1,000, right?
Yeah, 1,000 for tax withheld. Okay, cool. Yeah, so that's it. Let's hit continue. We're done with that slide. Again, I do recognize it's under the RRB 1099R, but we really wanted 1099R. But mistakes are made. I'm not perfect. All right, hit continue. Okay, we're going to go to Social Security. And you're going to see a lot of this at the website, or the VITA site, a lot of 1099 Social Security. So here's a takeaway here. Most people will have that document from Social Security. Sometimes they'll have a piece of paper that'll be generated by Social Security, which will have the same information that we need. So what we need is we need box 5, which are total benefits. And then unless somebody knows something different, I am not aware of any federal law that states that you have to sign up for Medicare. In fact, I know a person who is 71 years old, has never signed up for Medicare, will never sign up for Medicare. He just doesn't care. But anyway, but he does receive Social Security, so he's going to report the box 5 amount. And if you sign up for Medicare, which is, of course, minimum essential health coverage, then your premiums will be reflected on that SSA 1099. And this is a case at $1,700. Now, we're not going to do this now. We may see it once in a while. And John, if you can take your cursor and wiggle it by lump sum payments begin worksheet. What you have sometimes, individuals apply for Social Security and they may not get it right away. I know people who have received a lump sum for 8 years worth of Social Security. And then at that point, you'd open up the worksheet, you'd populate the worksheet. And yes, there is a description of this in the publication 4012. There's also an IRS Social Security publication, which has worksheets if you have someone who's received a lump sum payment. And I'll be the first to admit, I've done this before. I'm no expert at it. It does take a little bit of time. And so if you have a lump sum payment, then you want to slow down. You want to go ahead and reference the 4012 and then work through the worksheet. Okay, so that's Social Security. We're going to hit continue. And then we're going to hit continue. All right, what else do we have here? We've got those 2 items. We're going to cursor over. Actually, we're going to go to the right-hand side. I stand corrected, left-hand side. And we're going to go to capital gains. Okay, so when we talk about capital gains, we talked about you have a capital asset, you have disposed of it, which is a tax way of saying you've relinquished title to that asset. You no longer are the owner, and usually you relinquish title by selling it. And so we're going to go to the blue pencil and open up this capital gains transaction. This is shares of some corporation. He bought it in 2015. He sold it in 2022. That is a long-term held asset, which means he'll enjoy preferential tax rates, capital gains, long-term capital gains tax rates. I don't know what they are in 2022, but I know in 2021, the lowest rate was 0% based on income, and that's pretty good. Okay, we're going to go ahead and go to the middle of this document. We've got the sales price, and the sales price will typically be listed on a 1099-B. That's generally what you're going to see. And then, John, if you can hit that little caret where it says 1099-B and show us the other options. And so sometimes, not all the time, but sometimes you're going to have the cost is not reported to the IRS. If that's the case, we'll make the click on it. And then this is how I do business. I'll tell the client, say, okay, you don't have something to show the basis of your shares. What did you pay for them? And can you show me? Can you drill down to a website? What do you have to show? And sometimes they say, oh, Jerry, I have this letter from the broker from 1964, and I have a photostatic copy of the check that I wrote in 1964. I bought 20 shares of this for this amount. Okay, cool. Then that would be called cost basis. In this case, you did nothing else. You just bought and held on to it. But typically, you're going to see cost basis reported, and that's in that 1099-B. And as I mentioned before, 1099-Bs, you're going to look at them, and they're all different. They're not all cookie cutter. They're different. And I don't know how many brokerage houses there are out there, but I've seen literally hundreds and hundreds of different types of 1099-Bs. The vast majority of them have the information that you need. Okay, we're going to stick with the one we selected, cost basis. And then we're going to go to the cost. In this case, he purchased those items for $1,500. He sold them for $12,000. And so, of course, that the difference is going to be our capital gain long-term. The other items toward the bottom here, we're not going to worry about any of that. But John, if you can hesitate for a moment, sometimes you might have something that is within scope. And if it's within scope, then these are one of the boxes you want to check. Your publication 4012 is your go-to document for those in-scope transactions. All right, let's go and hit continue. And then we're going to go ahead and go over to the left-hand side and hit health insurance. And so in this particular case, he's in Medicare, and I'm not on Medicare, but what I know of Medicare, again, it's a voluntary thing. If you choose to get into it, you can. And of course, you have to pay premiums. The premiums, I think, are modestly priced. I've seen usually under $2,000 per person per year. In this case, he's not in covered California. And since he's got insurance, we're going to check. No, he is not in covered California. And we'll hit continue. As I said before, no state return. So I'm going to assess probably in the first week of January. These returns will be populated on your Lincoln Learn, your practice lab. Okay, we're going to go and hit continue. And then if you would, John, if you can go to the left-hand side and hit the e-file tab. And then just to kind of allay maybe some concerns, only a select portion of our St. Killian's team are going to have the abilities to electronically file, which means the vast majority of our people on the team will not have the permissions to electronically file. And so even if you attempt to e-file, you will be unsuccessful. You just won't have those permissions. So you don't need to worry about that. Just a few EROs on our team. And so in this case, we're going to go ahead, and this is kind of sort of how it's going to look like on the live tax layer. John's going to take his cursor and click where it says federal return. And there's a little caret there. And so here are some of the choices. Most of the time, your clients will say, yeah, give me a direct deposit. That's usually quick. It's usually safe. Usually it takes 5 to 7 business days if there's no issues. And then what we do with direct deposit, we make sure we confirm their routing number and their account number from their bank account. And then whether it's a checking or savings, and of course, the name of the financial institution. If they want a paper check, you know, I'm not gonna talk them out of it. I'll say, well, you know what, you can get a paper check, but direct deposit's probably quicker and safer. And if they go, no, I want a paper check, then okay, we'll check that. What happens is then a check will be issued to them, and it's not going to be days. It probably won't be weeks. It'll probably be more than a month before they get their check. I had a client last year who got a paper check, and it took him, I think, almost 2 months to get his refund. Okay, let's go ahead and make it paper check. This guy's a paper check guy. And then it says only transmit state returns. In some cases, for certain reasons, your EROs on the team will only transmit the state return. If that's the case, that will be indicated. But typically, we're going to transmit federal and state. Okay, cursor down. And then your email, we are going to capture emails, obviously, of the intake and interview form. That's important. You got to be able to communicate. The taxpayer PIN, that'll be usually pre-populated, and then that way they're going to go ahead and either agree or disagree with what is called global carry forward, which we're going to talk about. Go ahead and hit continue. We don't charge, so we can get past this screen. You know, here's another thing. Sometimes, and hopefully Fred's still online, sometimes people will bring in a box of donuts or a box of cookies and say, hey, VITA team, thanks. That's okay. But when they whip out their checkbook, the answer should be, this is a free service. We are supported both financially and every other way by the IRS and by the church. So no, we don't charge for the service. We do have custom questions. They will be set up. They're demographic questions. And when you see those, if you are a preparer or a quality reviewer, you'll populate those questions that'll be set up during live tax prep. Hit continue, please. Hit continue, we'll get past this. And then you can see large font. This is the refund. It's a green font, and that's a good thing. If it's black font, that means there's a balance due. So you're going to get a refund of $1,000. Okay, let's cursor down. Nothing for the state. State's not loaded. This will look a little different, but I want to go down to the bottom where it says return status. And so what we're going to do, if you're a preparer, you're going to say, hey, this thing is complete. And then if you are a reviewer, you put ready to e-file, and then their electronic return originators get into the system here, and then they'll e-file the return. You can see down there toward the bottom, mark tax return as complete. And so it'll look a little bit different than the actual live program. This is, as my brother would say, good enough for government worker. And again, typically we don't do state returns only. In some cases we will. But usually it's federal and state. Okay. All right, let's go ahead and save and return. John, at this point, you can open up that PDF document for the John Morgan federal return. Okay, we want to show this to kind of drive a few points home. This is how it will look. There we go. John, can you expand that a little bit from side to side? Perfect. Okay, so you'll have this this document. It'll look something like this. Let's go to the next page. You'll have a roll up with the various forms, to include in the right-hand corner the effective tax rate. This is only for the federal, and you're thinking effective tax rate is 0. That's pretty good. That's pretty good. In other words, this guy doesn't pay any income tax for this year. Okay, we're going to go to the next page. Just a roll up of his various income items. This is Social Security. Next page. This is your facsimile of the various documents that you're going to enter into the software. So this is one, and let's go to the next page. The 8879, this is a document that your clients are going to sign, and they'll be a wet signature, i.e. a pen, and they'll sign. If you would, John, can you cursor down in this document where they sign? There you go. So you're going to say your signature, and then of course, if it's a joint return, the spouse's signature. And as I mentioned before, and maybe somebody on this call, maybe you do care about this. I'm just going to tell you my opinion. I don't care about it. If someone says, I want my wife to be first in the return, or I want to be first, I'm thinking, doesn't matter to me. Whoever wants to be first is first. It doesn't matter. And what happens is when you file a tax return, if it's a joint return, then on your master file, you have both husband or wife or spouse and spouse. And it doesn't matter who's first and it doesn't matter who's second. Okay, all right, next slide. Okay, here's your SR. SR indicates senior, and so this is automatic. It's simply larger font. I appreciate it. I'm not 65 yet, but I appreciate larger font. And so this has the administrative date at the top. It has that question about digital assets, and then of course whether they were born after or before January 2nd. Okay, cursor down. We have no dependents. And so all of that is blank. You can see there's no W-2 income. Now you see right here, if you hesitate for a moment, John, this looks a little bit different than your 2021. You got line 1B, C, D, E, F, G, H, I, and Z. And so that's a little bit different. But at the end of the day, it's still a tax return. Okay, we're going to cursor down in this document. You can see the interest, $50. You can see the dividends ordinary at 100, and then his pension was 10,000. You see Social Security at 22,000, and there's a worksheet in here because only a portion of the Social Security is taxed. And a lot of people think that's unfair, and I simply tell them that's the tax law, and your software is going to calculate the taxable amount. In this case, it's a little over 3,000, and of course now we have that capital gain. And that's the capital gain, a little over 10,000. Let's go to the next page. And then we have total income on line 9, AGI, adjusted gross income on line 11, which means there's no adjustments. When you hear the term adjusted gross income, you're simply taking total income, subtracting any adjustments, and whatever's left is your AGI. In this case, he gets the standard deduction for a senior, which is a little bit more than guys like me. I'm not a senior yet, so my standard deduction is smaller than his. And then you can see his taxable income is $9,328. Now, this is the point that we want to make here. He does have taxable income, but because he's got the capital gains and he's at the lowest rate for long-term capital gains, which is 0, you're going to find that he has no individual income tax that he has to pay. And we go to the next line, which is line 16, where it says tax, and it's nothing. And when you first see something like this, the first time I saw this, I was scratching my head. I was an IRS agent. I'm thinking, what's going on here? I thought, oh, that's right. Capital gains long-term. He's in that particular, he's in that zone as far as income. He doesn't owe any individual income tax. Line 24, this is your total tax. What I do with my paying clients and my VITA clients, I can't explain the entire return to them because I'm not going to spend 8 hours per client. But I usually go to line 24 and I tell them, this is the total tax that you either have paid or will paid, which means that's what you got to do. In this case, it's 0 for him. So good for him. And then we go to payments. Payments, typically you'll have withholding for a VITA client. He's got 1,000 from his 1099. And that's his total payments on line 33. And then you can see all those other credits. The one in the VITA program you're going to see a lot is that earned income credit. And we have both a federal EITC and then we have a California state EITC. They have similarities, but of course they're different. They're different, two different tax systems. Okay, let's go to the next page. Total payments of 1,000. So that's what he's paid in, and he has some options. He can go ahead and he can push that $1,000 if he wants to next year. But in this case, he wants a refund, and that's reflected on line 35 alpha. And then of course we do this, and I know the VITA team. I didn't do this. The VITA team a few years ago, they came up with a system of collecting that routing number, account number. And then that's essentially checked off by the taxpayer, and then that way they get their refunds sent to them. All right, let's go to the next page. This is just your standard deduction chart, which means if you have and we do have a lot of seniors that come to the site, and what that means is they're allowed an additional amount. And if you have someone who meets the tax definition of blindness, then they get an additional amount. And then you can see that term qualifying surviving spouse is listed in the middle of the page. So that's your standard deduction. In the VITA program, the vast majority of our returns are use the standard deduction. Okay, next page. Even though this appears, this taxpayer, of course, used the standard deduction. If I remember correctly, I think we leave this in. For my paying clients, I take it out. It's a waste of time. It confuses the client. But for the VITA program, I think we leave it in. But what I do tell taxpayers is they go, "Hey, what's this?" Well, you get the standard deduction, and the itemized deduction is in here because it's automatic, but it's not calculated. You get the standard deduction. Okay, next slide. Interest and dividends, the Schedule B separates them. Interest at the top, your dividends at the bottom. And typically you're going to have a lot of different banks. People may have 2 or 3 different banks, so you'll have different line items. Okay. Go to the bottom, John, just a reminder. And I think this is out of scope, but this is something you probably want to know, just in general terms. If you have someone who has a foreign bank account, they may have a requirement to file a treasury document called the FinCEN 114. And if you have a foreign bank account and you are required to file a U.S. tax return, then you have to convert that currency into U.S. dollars and report that interest income on your U.S. Tax return. I don't think we deal with this in VITA, but it's good to know. Next slide. Capital gains and losses, you can see part 1 short term. They're separated from long term. He doesn't have any short term. And if you can go down just a little bit, John, I want to point something out. This would be line 6, and it says short term capital loss carryover. This is within the scope of VITA. So if you have a carryover from 2021, that means we need the 2021 tax return, and we're going to plug in that carryover amount if there's any. And then if you go to part 2, he sold some shares. He had a gain, and then he had a capital gains distribution. That's on line 13. And then you see the total amount of long-term capital gains, which is taxed at a preferential rate. And then same concept for the carryover, line 14. If you have a carryover from 2021, on line 14, you're going to plug in that capital loss carryover. So, okay, and how about the next slide? Just a continuation, next slide. This is the form that has the breakout. We talked about this before, the 8949. We talked about this before. If you have someone with 500 transactions, this is how I'm going to do business. I'm going to say, well, if it's within scope, we're going to probably aggregate most of those short term, and then we're going to aggregate most of those long term. We're not going to have someone type in 500 entries, because that's a lot of keystrokes, and that'll take them probably about a week and a half. But anyway, I aggregate. If someone has a different idea, you can bring it up to me, but I'm gonna go ahead and issue the guidance. Let's aggregate. Okay, next slide. This is what you would call your money slide, because a lot of people say, well, gee whiz, Jerry, you've got taxable income. Why is there no tax? My answer to that is long-term capital gains tax rate. This is the document that reflects that. You can see on line 1, there's your amount, your 9,328. And as you go through the worksheet, you can see based on that long-term capital gains tax rate, there is no tax that the individual has to pay on this taxable income. And if you cursor down a little bit, John, you'll see the rest of the form. And it's nice when you first see this, at least to go through it with your client or maybe hit a couple lines, but you need to be aware of this one, especially when you have something like what we have here. Next slide. Okay, yeah, just this is right out of the instruction booklet from the form 1040. And then is that it? Maybe 1 or 2 more pages? Okay, you can disregard this. There's nothing there. Your Social Security benefits worksheet, this is really important because a lot of people think Social Security benefits are not subject to taxation. Well, the answer is it depends. And so if you go through this worksheet, if you do have that, in this case, there's an amount that was calculated. You have your threshold amounts of 32,000 and 25,000, which are reflected in the middle part of the form. But the bottom line is this form will go through what remains as far as a taxable amount. And so if he cursors down toward the bottom, it's a little over 3,000 and change. And that is defined as taxable Social Security benefits. In his particular case, it's added to that amount. But again, we know that that long-term capital gains, there's no tax for this guy. So anyway, that's the worksheet. So sometimes people ask you, why are my benefits taxed in part? Well, they're taxed in part because you make too much money. And this particular worksheet will show you how to calculate the taxable amount, which is included which is included on page 1 of your Form 1040. Okay, and is that it, John? I think that's it.
Yeah, I do have,
Okay, so
there's a question from a while ago.
Okay,
And it's
yeah, go ahead.
Yeah, it's about the 1099-R. If you're using the simplified method, the worksheet, what happens if we don't have, the amount previously recovered?
I guess my answer would be to you is you want the taxpayer to secure their returns from previous years, because in previous years they've recovered amount. Because the whole idea is if you have basis in your pension, once you recover all that basis, then when you receive your pension payment, it's a fully taxable event. So that's part of the record keeping requirement that the taxpayer is going to have to do. If they don't have the returns, they're going to have to reach out to the IRS and get that information.
Okay, thanks.
All right. Okay, I've got 12:14. Let's go ahead and take, how about a 6-minute break? Come back at 12:20 and let's run through our next return, which is the Moscosco return. All right, so John is going to change the tax year to 2021. In Lincoln Learn.
It's done. Can you see it?
No, it's not loaded.
Oh.
Okay, there you go. Okay, so you can see in the upper left-hand corner where it says 2021 tax program. So we're going to use this to show you the state portion also, because 2022 state is not loaded. So John is going to go to client search. And he's going to go to the Moscosos, which is, you'll have to cursor down a little bit or do that. There you go. So we have Edward and Althena Moscoso. And he'll select that return. Then he'll go to the left-hand side of the screen. And he'll start with basic information. And then filing status for our taxpayers. They've chosen to file married filing joint. And then we're going to continue. We've got Edward. He's chosen to be the first on the return. And he's going to contribute or direct the government to contribute $3 to the presidential election campaign fund. And then we've got Althena. She is second on the return, and she also is going to have that $3 order to the government for the fund. And you can notice that Althena is self-employed. Okay. All right. Then we have their contact information, their address toward the bottom. And then we've captured phone numbers. We don't have an email address, but in the VITA program, we're typically going to get an email address. And we're going to hit continue. And we do not have any qualifying dependents, so we're going to hit continue and move on. All right, we've got a W-2. Very top. And we're going to open that up, and that's for the husband, and that's for Edward. And so we've got the employer identification number. And what we do with W-2 is we key them as we see them. That's the general rule. And you can see here in wages, he's got 18,000 in wages in box 1. And he's got tax withheld of 1,800. And I can tell that he does not have a 401k because box 1, 3, and 5 are all the same. If he had deferred compensation, then box 1 would be less than box 3 and 5. And then, yes, we also have box 13. If you have someone in a retirement plan, we're going to key it as we see it. We're going to check that. Okay, so we have tax withheld of 1,800 federal. And then what John is going to do, he's going to go to the Medicare tax, 260. And sometimes it'll be different than that auto population. So he's going to change that to 259 and see if the computer takes it. There you go. And so again, keyed as you see it. Box 12, he'll open that up. And that's deferred compensation. And when you open up that code, you're going to get different codes to include deferred compensation, which is D and Delta. If you have health insurance, then that's DD, Delta, Delta. And then you would key it again as you see it on the W-2. Box 14, you can see they've got state disability insurance. Not everybody pays it. I've lived in California for, I don't know, 35 years or something like that. And I think for about 34 years, I didn't pay a penny into California SDI. So it just depends. If you're a federal employee, you don't pay into it. Certain people do not pay into it. He does, to the tune of $180, which means if he gets sick or hurt and he qualifies, he can get the state disability payments, which are tax-free, not reported on his federal return and not reported on his California return. The Medicare waiver payment that we talked about, that's the so-called Roseville, California W-2s. You may see that where someone is caring for a loved one and they receive Medicare payments or Medicare waiver payments. Again, they're being compensated for caring for a loved one. And then we go to the bottom, our California information, our state wages will typically be the same. In this case, 18,000, and then state tax paid, that's state withheld, and that's 500, which is also going to be reflected on Schedule A as an alpha. And then we don't have any local wages. There's no jurisdiction in the state of California other than the Franchise Tax Board that has individual income tax. And so we don't worry about 18, 19, and 20. And then your state EIN in box 15, that'll be different than your federal employer identification number. Okay, we're going to hit continue. Those are his wages. And then we're going to hit continue. We're going to go to interest and dividends. So in this case, we open up the interest and dividends tab. And we've got interest from a bank. So we open that up and we'll key it as we see it on the 1099 INT. you can see in this particular document, they've got interest income in box 1 of $25, and they broke their agreement with the bank. So the bank has the early withdrawal penalty in box 2 of $10. And that early withdrawal penalty will become what is called an adjustment to income. All right, so we're done with that. Let's go ahead and hit continue. And we're going to go to the Schedule C as in Charlie. And then here's our dashboard. And so we know net income is 24,000 and change. And of course, SE tax is going to be assessed on that. We'll open up the Schedule C. And basic information, this is something that you're going to go through. A lot of your taxpayers will not have a doing business as, and so we'll just indicate who it belongs to. And we have to, of course, plug in some type of business code. And what I tell people is you try to get a code as close as you can to the line of work they're in. You're not going to agonize for 30 minutes on a code. You're going to, as my brother used to say, you're going to get it close enough for government work. Okay, hit continue. And then we're going to go to questions about the business. And because this is a VITA return, it'll always be the cash method of accounting, which is defined as you're going to report your income when you receive it. You're generally going to deduct your expenses when you pay them. We don't do accrual basis in VITA. We don't do inventory in VITA, so we can leave that cost tab alone. Material participation, that's automatically checked. You leave that alone, which means they're engaged in a regular and ongoing basis. And that's what they're going to do for VITA. Okay, we'll hit continue. We go to income, open that up. And this is what I always tell people when we're working with a self-employed individual. I always ask them, tell me about all of the income that you received as a self-employed individual. And I'm talking about coins, currency, checks, Zelle payments, everything that you received. That's called gross receipts. Some of it may be evidenced by a 1099 of some kind. Some of it may not be. It doesn't matter. What matters is tell me about all of your income. And then once we've established that, I plug in the total amount of income that they received. Okay, we hit continue. And then we're going to go to general expenses. Cost of goods sold, you can ignore. We don't do that in VITA. That's for a retailer. We don't do that. And so we go to general expenses. In this case, what do we have? We've got some supplies and we've got a license. Oh, here's something. If you engage in a business and you're supposed to be licensed, you're probably violating some type of California code. But for the purposes of our return, we're going to report income or report expenses. If you need to get a license from the state of California, my only comment is go get the license. But again, you still have income and expenses. You're going to get that on your federal return. Okay, we'll hit continue. And then we're going to go to car and truck. You see a lot of this, and we're going to open that up. In the VITA program, we only do what is called the standard mileage rate. We don't do actual miles. And so this is what you would populate: type of vehicle, when the vehicle was placed into service. And then you would differentiate between business miles, commuting, and other. Business miles is what you're going to get a deduction for. All the miles you drove in your business. Commuting is going from your house to your job, whether it's a W-2 job or self-employment. Other is going to church, laundromat, visiting friends and relatives, taking vacations, things like that. Those check marks down there. Go ahead.
I was going to say, Jerry, this is the 2020 return. In the 2022 return, there'll be 2 boxes for business, depending on the first half of the year and the second half of the year.
Good point, John. Yeah, in 2022, because the mileage rate, the business mileage rate is different from the first 6 months and the last 6 months, it will differentiate. And so your taxpayer then, of course, has to have a method of recording those miles and when those miles were incurred. Good point, John. Okay, and so these check marks right down here, you just ask the question. Typically, most of those will be checked. And when people say, I don't have any information, I always tell them, yeah, you do. Because you register your car, you buy gasoline, or you have an electric car, you plug it in and you pay for it. Everybody has some type of evidence to support the deduction. They may not have all of their evidence, but they have some type. And so the answer would be, yes, you do. And where it says written, some people kind of go back and forth. It can be written in electronic format. It can be written on a piece of paper. It's all written. Continue. And then we're done with that. Okay. And we don't do depreciation in the VITA program, so you can ignore that. And we don't do business use of the office, which is a home office. We don't do that. Okay, we'll hit continue. Now we're going to go to other income. Oh, there's your dashboard, which helps out. So other income, we're not going to open these tabs. We're just going to explain them real quick. And so when I talk to people, I ask them, tell me about the income that you receive. And sometimes they go, well, Jerry, some of it's not taxable. I'm thinking, humor me. Tell me about all of your income. And then if I don't know it, I'll look it up. If you know it, then you tell me, and then I'll still look it up. Because a lot of people will receive income. They go, oh, it's not taxable. I'm thinking, well, but tell me the story. Maybe it is taxable. You're at a tax site, you're with tax people, but let's see if we can help you. So in this case, federal purposes, the lottery income is taxable. Jury duty pay is taxable, period. Now, if you take your check and give it to your employer, then you can take what is called an adjustment to income. But you're going to, step number one, you're going to report it on your return as income received. And then prizes and award, if you accept it. If you don't accept it, I think I told the story one time. I got a call, Jerry, you won something from this mall. What is it? It's this and that. I don't want it. Keep it. Not interested. Hung up the phone. I refuse the prize. If you refuse a prize, that means you did not take actual or constructive receipt. It's not a taxable item. Okay, so here are the other income items. We're good to go here. We can hit continue. Let's go to other. Oh, don't open this up, but K1 earnings, that's the tab that we talked about. So if you have a K1, don't get frightened. Just open up your 4012 and say, okay, I need to take certain things off this K1 and plug it into the software. Let's open up other adjustments. You can see in this case, the jury duty pay, then step number one, we reported it. Step number two, we turn over that jury duty pay to our employer. And then the net effect will be zero. But that's what you got to do if you turn it over to the employer. You take an adjustment to income. Let's go to itemized deductions. All right, and then we're going to open up where it says gifts to charity. That's the first entry we had. And then we had non-gifts to charity, which is the second tab. These are miles. And so if you're working with a charity, a lot of people do, and they're driving on behalf of the charity and they're not reimbursed, then they would go ahead and plug in their charitable miles. And if they're allowed to take itemized deductions, then that deduction will be calculated.
Driving to
Okay.
VITA. Yeah.
Yeah, if you go to
Yeah,
VITA,
same thing.
it's, yeah. And a lot of people do Meals on Wheels. They'll be associated with the senior organization, helping out seniors, going to their home, driving around, shopping with them, maybe taking them to the doctor, all part of charitable miles if it's a charitable organization. Okay, let's hit continue. And then we're going to go down to our next tab. Oh, hit continue again. And we're going to go down to where it says other itemized deductions. This is on your federal return. In this case, we have gambling losses to the extent of gambling winnings. And so that looks like a lottery ticket. Okay. Anything else, or is that it? Okay, that's it. All right. And then let's go to federal estimated tax payments. And that would be on the left-hand side under payments and estimates. And we open that up, that blue pencil, this individual made quarterly payments. And you can see it's $300 per quarter. And then of course the software will calculate that. Okay, total amount of $1,200 federal. And then we'll hit continue and go to state estimated payments. And we open that up. And those are your quarterly payments. So the takeaway here is if they have that information, they'll have that recorded. And that's a great thing if they're making estimated tax payments, because the general rule is they want to meet 90% of their tax liability during the year. Okay, let's hit continue. And let's show you something you're not going to see on 2022. So we'll go down to recovery rebate credit. And that's toward, there you go. So if you're preparing a 2022 return, you will not see this. It doesn't exist. If you're preparing a 2021 return, you simply have to ask the taxpayer, did you receive any of those economic impact payments? And if you did, how much? And if you didn't, then you check no. In this case, no. We'll hit continue. And then we're going to cursor down on the left-hand side. And we're going to go to health insurance. In this case, they're in covered California because we only do California returns. And so when you talk about the health insurance, this is for covered California. If they get that 1095A and then that state document. So we're going to open that up. And this is a simplified one. You want to verify your household members. This is the tax household, which is in this case, husband and wife. We're going to hit continue. And then you're going to answer these questions for the 1095A. In this case, again, we're looking at 2021. So it asks about unemployment compensation. Did they have to repay any of the advanced premium tax credit? No. Did they have any changes? On the 1095A, sometimes there'll be no changes. It'll be the equal premium amount for all 12 months. And in this case, it is. And so you go to the 1095A, you look at line 33 alpha, 33 bravo, and 33 Charlie, and you're going to plug in the amount. You're going to key it as you see it on the 1095A. Okay, hit continue. And then we're going to jump into state returns. So John, if you'll click that blue pencil. And so let's point out a couple things here. Let's get through this stuff. So yes, we're an Orange County resident, which means continue. And yes, the address is the same on the return. And yes, they do have full minimum essential health coverage. And yes, they're in covered California. So then it brings up the information regarding covered California. Yes, they're enrolled. And it's asked about repayment cap. There's no data here, so we put no. And then it says premium assistance subsidy claim and reconciliation of advance payment of premium assistance subsidy. Wow. Anyway, we'll address that. So we go into that. And in this case, the 3895, it asks about coverage. Are there any changes? Let me restate that. It says, do all the forms include coverage? And the answer is yes. And you can see for this particular section of the software, it asks about the premium amount, and they're all the same. For instructional purposes, I just left it all the same. But again, you'll need those California forms that are issued to the taxpayer along with the 1095A. Okay, we hit continue. And then we're going to answer those other questions. What I remember about covered California and the Affordable Care Act, we don't address part 4. We don't address part 5. So my understanding is you always put no. Okay, we'll hit continue. And then John, if you would go to additions to income in the second tab. Okay, in this case, it asks about additions to income. This is where we have that non-conformity. So certain things that are not taxed by the federal government and are taxed by California. So we're going to open up that other addition. And that would be the edit tab. And in this case, it says alimony. So these guys are either the husband or the wife, or maybe both. They had alimony that they received. And for California tax purposes, it's a taxable event. And for new divorces after 2018, new divorce decree, what that means is on your federal return, you don't report alimony, you don't report the alimony paid. On your California return, you will have to report alimony received. And John, can you open up those 3 little dots? All right, so you see where you can edit and or delete if you have to. Okay, we're done there. So that's an example of an addition. Let's go back. Let's go to an amount. Yeah, back. Let's go to a subtraction. And so in this case, as it says up here, these are the items that you're going to subtract from the California return. So that means the federal government taxes it, the state of California does not. And now there are certain things that are done automatically. Unemployment compensation is done automatically. Social Security is done automatically. So we're going to open up the California lottery winnings. And what we have to do is we have to subtract California lottery winnings from the California return because California does not tax California lottery winnings. And then we're going to go ahead and hit continue. And let's go ahead and hit continue again. I think that's how we get out of here. There we go. Let's see, what else do I want to? I think we've already addressed that. Yeah, I think we addressed everything we need to address. So, okay, let's go to our itemized deductions. Or, wait, state credit, state credit. Let's go to state credit. And so we do know that a lot of our taxpayers are eligible for the California renter's credit, which means they rent their house, their home, and it has to be based in California. They have to pay rent for 6 months or more. So John's going to open up the renter's credit, and you're going to identify, and we do this in the intake form. Are they renters? And if so, do they rent California property? And if they qualify, we'll put yes. And then we don't do military personnel at St. Killian, so we'll leave that no. Okay, we'll hit continue. And I think we've hit everything we needed to hit. So let's go back. And let's exit the return. And let's go ahead and let's go back to now our PDF document for our taxpayers. Okay, this is the Moscosos, if I'm pronouncing that right. This looks similar to the other one. This is 2021. We're going to go to the second document. You can see, if you cursor down a little bit, you can see all those various forms that are included in the package. Here's your roll-up, this quick summary. This may be of use to some of you. This might benefit your client if you're going to go through this summary as opposed to each and every page. And I wouldn't recommend going through each and every page. I've done that a couple of times, and it's very time consuming. And quite frankly, I just don't think you're going to do it, because at some point you're going to say, I've been with this guy for 5 hours. It's time to move on. Okay, let's go to the next page. Okay, just information about his W-2. And next page. This is the facsimile. Okay, next page. This is what we call our disclosure, which if you go toward the bottom, we call it global carry forward. All this means is if they want to agree to it, then the next year when they go to a VITA site, then what happens is permissions can be given and people can bring up the return. And also it's easier to prepare a return for global carry forward. The short answer is if they say no, no problem, move on. Next. 8879, same concept. We share this with the taxpayer. It shows a number of things to include their refund or what they owe. And then toward the middle of the document, it has a lot of disclosure information. And then, of course, signing. Once they sign the document, then that gives us permission to electronically file. Okay, next slide. This is the voucher form. Sometimes they owe, and if they do, if you cursor down, there's a little voucher that they would send off. They would write their check to the U.S. Treasury, and they would send it off. On page 2, if you cursor down a little bit further, you're going to have a mailing address. And for the state of California, that'll be Cincinnati and Ohio. Oh, cursor down just a little bit, John. There you go. Oops. There you go. And so that would be the address. They would send their check and then make the check out to the U.S. Treasury. Okay.
You could pay online too, right?
You can pay online. If you want to pay in person, I don't think the IRS accepts cash.
Yeah.
The closest office I can think of is in Santa Ana, but they will take checks. Okay, next. And here's your return, your 1040 for 2021 administrative data at the top. If you go, yeah, the virtual currency statement for 2021 is a little bit different, but the same concept. We don't work with taxpayers in VITA if they've sold virtual currency. That's outside of scope. You get into the return, you can see W-2 wages on line 1, interest income, line 8, that's going to be your self-employment. And then you've got your total income. You've got your adjustments to income, which we're going to show you in a moment. And then, of course, they take the standard deduction. And then you'll notice on line 13, that's a very generous deduction, the qualified business income deduction. It's 20% of the net income, and that'd be for the taxpayer wife here. Taxable income is a little over 13,000 and change. Next page shows your tax on that, which is 1,333. They have self-employment tax, and all of that tax adds up to 6288. They have tax withheld of 1,800. They've made estimated tax payments of 1,200 federal, and they're entitled to that recovery rebate credit. Just a quick pointer, if you're doing 2021, make sure they look in their bank account to determine the economic impact payment. And you want to make sure that you differentiate between the economic impact payment and the federal tax refund, two different animals. Total payments 5,800 and they owe 6288. So the difference is 488. And then again, they can make payments various. They can also do direct debit if they want. And I remember one guy says, Jerry, I don't want the government to know my bank account. And I told him, I said, sir, the government already knows about your bank account because when you open it up, you gave the banker your social security number. So yeah, the government already knows. Okay, and then next page. This is your Schedule C as in Charlie. That's your net income on line 3. Okay, and next page. Oh, here we go. Jury duty pay. This is income. Step number 1, you report it. Prizes and awards, you report it. And then your lottery winnings, you report it on your federal return. And then all of that adds up to line 10. Your adjustments to income, we did have that 1/2 self-employment tax calculated automatically, penalty on early withdrawal. And then I think we had, there we go, your jury duty pay. Again, only if you give your pay to your employer. There, like when I was a government employee, go to jury duty, get paid, turn around, give your check to the employer. And then those are your adjustments on line 26, adjustments to income. Additional taxes should be, oh, here we go. The excess advance premium tax credit repayment. You will see this once in a blue moon. And you say, what the heck is that? It simply means the taxpayer, they received too much of a subsidy from the government. And what probably happened, they did not update the Covered California data. And when you see that, that's all it is. You're paying it back. The government paid you too much. Now the government wants it back. You don't see it very often, but when you do, taxpayer scratches their head and say, what's that? And so you tell them, you received too much of a subsidy. You got to pay it back. Your self-employment tax, that's going to be approximately 15% of your net income, approximately. Okay, cursor down. Other taxes, I don't think we had any of that. Cursor down. We had a standard deduction, so this doesn't apply. It automatically populates. Okay. Next slide. We had some interest. That's reported here. Not the amount that's was withheld. That's an adjustment to income. Here's your profit and loss. This is something you want to spend a little time with your client. Gross receipts, just confirming that's all of the income they received. And again, if they start the conversation about 1099, say, okay, I got it. But at the end of the day, what did you receive in income? The total amount, the total amount. And then once you have them focused and they say, okay, well, I've got this. And your taxpayers sometimes will say, well, I don't know what I earned. And I have learned that taxpayers know usually to the dollar, sometimes to the tens of dollars, what they've got as far as gross receipts if they're self-employed. They know, and they have a method of accounting for it. It may not be a perfect method of accounting, but they've got a method of accounting. And then here's your vehicle expense, 1680. You got some supplies, a license of some kind. And then we've got our net income reflected on toward the bottom. And that would be cursor down a little bit more. There you go. 24,195. And that's net profit. Okay, next slide. Cost of goods. We don't do in VITA. Information pertaining to the vehicle, your business miles, and that's your deduction. And this is really important. If you've got someone who's driving their vehicle for business, they should have a method documenting their business miles. If they don't, if they ever get audited, and it's not like they're going to, but if they do, the first thing the auditor is going to ask them is, how did you determine your business miles? What method did you use to account for that? And it doesn't have to be sophisticated. If it's sophisticated, great, but there has to be a method. Okay, part 5, we don't have any of that, but sometimes you'll have certain things. And we talked about this. If you have a guy or a gal with a cell phone and they're in business and they have one cell phone to their name, and they're like me, they pay I got a cell phone and I use it for my business. I use it for all sorts of stuff. And I cannot deduct my cell phone on my tax return. Because I don't have it itemized, it's just one flat fee. And if Jerry Muir, a tax practitioner, can't deduct it on his federal return, neither can a VITA client if they have just one and they don't itemize that cost. Anyway, no cell phones on returns. That's the general rule, unless they have a cell phone dedicated to business. Here's the SE form, and this is the self-employment tax. I use the term approximately. When you go through it, it's, again, approximately 15% of net income. Okay, next slide. QBI, you could spend all day trying to explain this. I just tell people it's 20% of your net income. And if you go down to the bottom, you'll see that calculation. Next slide. Here's your premium tax credit. This is, if you go toward the bottom of this form, this is where the person had to pay it back. And again, we keyed it as we see it from the 1095 alpha. You can see on line 29, if you see line 29 on this form, that's that excess. That means they received too much of a subsidy. And it's really painful for taxpayers. But again, if they're in covered California, they have a requirement to go in there and change what needs to be changed as things change in their life. More income, one less wife, one more wife, something like that. Recovery rebate, again, just based on did they receive the payments, and if not, then they may get this. In this case, they did at $2,800. Again, the recovery rebate credit doesn't exist for 2022. Here's your California return, and you can see they have filed jointly. That personal exemption for 2021 is $1.29 each. We cursor down. We can see your state wages, same as federal. Our AGI, that's the federal AGI. Then we subtract that $1,000, and that was the $1,000 for the lottery, not taxed by California. And then we added $5,000, and that's for the alimony that California does tax, the feds do not. And then you can see where it says the deduction. In this case, they got the standard. We'll still take a look at the itemized document, though. But again, standard deduction, taxable income. Taxable income from California is going to be different from taxable income from the federal government. Again, I use the analogy dogs and cat, and most people say, okay, I got it. Tax table, that's line 31. That 536 is the tax on that 36,000 and change for line 19. And then you apply your exemptions to it, and then you're left with 278. And then we cursor down. I think we still have that. There we go. Non-refundable renter's credit, 120, brings them down to 158. And then we've got that excess advance premium assistance repayment, which means, again, they received too much as a subsidy. And so that gives them a total tax of a little over 1,700. We've got the withholding, we've got the estimated tax of 1,500. And so that means when you go down to the previous one, Oh, John, go up just a little teeny weeny bit. Go down a little teeny bit. Okay, on line 91, you typically won't see this, but we have to ask a question. Do they have use tax, which means have they purchased a big ticket item in another state, brought it to California, like maybe a car? If that's the case, when they register with the DMV, they're going to pay use tax, because if they're paying 5% sales tax in Kansas and 10% sales tax in California, the difference is use tax. So sometimes you do see that. Okay, we're back to our return and we've paid in 1,500. And let's see, cursor down, we owed a little bit more than that. And so the difference is, there we go, $208. Or cursor down. This page right here is for all of your voluntary contributions. And if they've made contributions to various organizations, you will select that. In this case, they owe, so they can get direct deposit. They can, direct debit, I should say, direct debit, or they can pay by check. And of course, if they have a direct deposit, they would do that. Here's your adjustments. This is something, if you're not familiar with this or you kind of forgot, just go back and look at it. It'll list the federal amounts, and then you see column B as in Bravo, column C as in Charlie, and those are your subtractions and your additions for California purposes. And so when John cursors down, he should see, here you go, the gambling income. Gambling income is going to be reported. And let me restate that. The gambling income is not going to be reported because that's California lottery.
Right.
So that'll be a subtraction, column B as in Bravo. And then we go down to the next one, and we should see the addition of the alimony. The next page, column C, there we go. That's at $5,000. Oh, I'm sorry. Yeah, here we go. It says California lottery. That refers to that first column. That second column is going to be your alimony. I think that's how we broke it out. Okay, next page. Okay, next page. So this is your, next page. You got to get down to itemized deductions. Here we go. If you go to the very top of this page, sometimes you're going to have an individual that will not itemize on their federal return, but they will be able to itemize in California. Every once in a while, you see that. Most of the time, when they itemize on the federal, they'll itemize on the state. And this is where you're going to have to be aware of certain things. Like, for example, state and local income tax. So we would refer to that as your state tax you pay to California, and also SDI is also a tax. So that will be subtracted on line B as in Bravo, which means it's not part of California itemized deductions. If you cursor down a little bit more, John. Okay, that's all we had there. Your interest on your home, that's probably not going to be changed. You probably not going to see that in VITA. Next page. Here is where you will see, your gifts are probably not going to change. We don't do casualty and theft losses. If someone has a casualty and theft loss, California rules are different than federal. Go to a paid practitioner. Cursor down a little bit more. Yeah, this is where you're going to see perhaps some differences. Maybe they have, if you cursor up, maybe they have tax return preparation, can't get it on the federal, it would appear on the state. Maybe they've got job union dues, doesn't appear in the federal, will appear in the state. You got to make those entries in the software when you're in your federal return. I think that's it, John. Is that our last page? Close to the end. Okay, some other information. Facsimile of the W-2. That's your premium assistance subsidy. Again, for instructional purposes, we threw that in. You may see that once in a while. Okay. Page 2. If I remember correctly, and someone will have to correct me, I don't think we have people sign the California 8879. I think we just have them sign the federal one.
Yep, that's right.
Okay. And then if they owe, then of course, they're going to maybe a voucher, different ways to pay. If you want to pay in person, I think there's a franchise tax board office in Santa Ana, or most people just send a check, or you can pay online. Okay, I think that does it. John, any questions? We're over a couple minutes, but I'll tackle a question if someone has one.
The one said about how is the middle class tax refund? I guess that's the one we got recently handled. I think that's a nothing, right? It's not,
Yeah, that's a
it's not
nothing.
income. Yeah.
Yeah, it's not reported income on your federal return. It's not reported on your state return. All right, then I will remind everybody, again, please join us. You'll see an email go out regarding the California session on January 14th. And look forward to other emails. And if you have a question or a comment or something, shoot me an email. I'll tackle it in a day or two. But otherwise, hey, thanks for joining us. And I think we're going to have a lot of fun and really help out a lot of people. John, I'll throw it back to you, as they say in the
Yep.
newscast.
Okay. No, nothing else for me.
All right. Okay,
Have a good
everybody. All
holiday. Yeah.
right. Take care, everybody. Merry Christmas.
Thank
Bye-bye.
you.
Bye.
Thank you.